Yo, a little bit earlier, not as early as I fully could have made it, but I did want to eat and relax a bit before I go into this. So we're here now. On episode 19, yesterday we went over a chart and we pretty much grasped a lot of the concepts he talked about yesterday. So we're pretty much in a good position to continue on without really needing to kind of do any like going over everything. The main kind of takeaway from me was the relationships between multiple fair value gaps, especially when you have a higher time frame one. And when it's in the same time frame, you kind of use the higher one or the first one mainly. But when it's a multitude of time frames, you can utilize the parent fair value gap as the basis. Now, there is an example of which we had where there was multiple fair value gaps. Let me see if I can find it. Probably if I only 32 times. Here we go. There's two fair value gaps of which we anticipate price pulling back into the first one, but the second one is our entry. So in this instance, zoom in a bit. Fair value gap here, fair value gap here. We anticipate price pulling back, but we enter in on the first one right here. Bam. Okay, episode 19. Let's begin. I'm actually too hot. Wait, hold on. Hold on, I gotta do something real quick. What's this one say? I'll be back, sorry. And I just started the stream, but I gotta go. I'll be back in like 3 minutes, maybe. back. Apologies. It was a bit of a longer break than I wanted, but sorry. Have to go.
All right, folks, welcome back. A little bit of a different type of presentation style tonight. I'm going to be blending both of my communities. Okay, I have a private mentorship group, which I usually do a midweek review and commentary and teaching with on Wednesday, Monday, and Friday. And then obviously, the YouTube mentorship group, you all get a video from me on Tuesday night and on Thursday night. Well, this is part of the video when I talk to my private group. I do a little bit of jawboning, so bear with me because I'm trying to save myself a lot of time. I went on holiday last week and we went down to Florida, did some gumshoe detective work, found some interesting things, and I'll bring it up in the coming weeks. It'll be a little interesting. But in the meantime, I came back obviously late, we had a lot of traffic, and it delayed me. I couldn't get back home to do the video for the YouTube community, and I got home late today and had a lot of admin tasks to do because of mentorship and businesses that I'm running. So with that said, just know that this is not going to be a regular thing. I'm doing it because I have a lot of work to do when I'm producing these videos for my private group, so I am blending both. Okay, so I'm going to cover what I promised I'm going to cover in the YouTube commentary on Tuesday night, but was unable to do so. And then also I'm going to give the private mentorship group their commentary and blend both communities together. Okay, so it'll kind of give you a little bit of an appreciation for just how much I really am teaching here on YouTube. Okay, and just so you know, I know there's a lot of you that are commenting in the videos and you're asking how to join the private mentorship group and what is the distinction between that and the YouTube community. Well, the private mentorship group, they get to see things before it happens. Okay, I call moves before it happens. I call analysis. I break that down before it happens, and I'll give you a little taste of that. What was given to them on Monday night, and I'll use that to segue into the teachings that I promised I would give to the YouTube community on Tuesday night, but wasn't able to. And kind of give you also a preview, kind of like what I'm going to be doing when I start doing live streams. What do you say? ICT's going to be doing live streams? He said he was going to do live streams. Didn't they say he would never do that? Yep, it's 2022. I'm doing everything they said I wouldn't do. Okay. So anyway, the point is, I'm going to give you a little bit of a taste of what I'm going to be outlining in real time with intraday charts. Okay, which is a lot easier because it's quicker, number one, and it won't feel quicker when you're watching it with me. Okay, it's going to be probably me droning on about things while the price action's moving. Okay, so I'm going to drive most of you that don't like all of my lectures where I have a lot of insight being shared and things that you don't think are relevant to you because you want to get to give me an entry pattern, give me a targeting technique, and that's it. That's all I need. That's not all you need. Okay, because if it was that easy, everybody would be rich. But I understand everybody has to go through that growth period. But when I get to that part, I'll tell you this is the part where I'm going to show you basically what I'm going to be doing in the live streams. Okay, so with that, I just want to make this point here because my private group, you know who you are. I have been telling you for over a year now to download all of your videos, okay, because the server will not be hosted any longer starting June 1st, 2022. As I mentioned, we're going to be moving away from videos and we're going to forum posts only. So everything I say usually in audio commentary over a video, I'll be just simply typing out on a chart because you're all now charter members, so I don't need to do so much legwork with the audio, okay, or commentary. I can point to certain things and you know exactly what I'm referring to, what it means and what it's useful for. And then obviously I'll point to where it's going to go before it's going to go. So there you go. Makes things a lot easier, quicker for me, everyone else as well, and it doesn't cost me a fortune to run this community. It's rather large, and since you all don't pay anymore, I'm not running a mentorship anymore where you pay me. Okay, no one can join this. So that's the distinction. They get to see analysis before the fact and incorporate the things they learned. Whereas on YouTube, I'm giving you one specific model, a bread and butter approach, where you can literally go in. There isn't a lot of moving parts. I stripped it down to its chrome. Okay, no fluff in it. Okay, straight to the brass tacks. Now, the same thing I've done with this YouTube model, my mentorship that is chart member, they can do the same thing with what was taught to them. They can strip it down, or they can make it as intricate and complex as they want. That's the private mentorship group. It goes into a lot of detail that is honestly overwhelming for the majority of them. And as I mentioned when I promoted it, it's only for the freaks that want to just know everything. Okay, not that it's going to be useful for everyone, but in contrast to what they get and what I'm giving you on YouTube, I've literally laid a working model with very easy rules that don't really go beyond what I'm going to show so far. That, in my opinion, can make you consistently successful analyst. Let's say it that way. Because I can't promise profitability. No one can. The only thing I promise, and this is what I promise in my private mentorship too, I promise that you're going to learn how to read the markets better than anybody else would be able to show you. And I can prove that these things work. I do it every single week. Every single week I outline these things. And if it doesn't work, it won't hold up. So right away you can read the comments in the YouTube mentorship and you can see people are really excited because they're seeing the results of simply going in and looking for the things I've outlined. I'm not giving you a lot of different things to look for. I'm giving you a very specific thing during a specific time of day. And if you focus there over a period of time, you'll start to see things that repeat over and over and over again. Now they're going to have subtle differences, but they generally have the same framework. And what do I mean by that? Well, they'll have certain signatures in price where it creates the fair value gap. And then it breaks a low, comes back up.
I blanked out for the past literally minute, so I was thinking about something completely different. That's not good. Let's go again.
That don't really go beyond what I'm going to show so far. That, in my opinion, can make you consistently successful analyst. Let's say it that way. Because I can't promise profitability. No one can. The only thing I promise, and this is what I promised in my private mentorship too, I promise that you're going to learn how to read the markets better than anybody else would be able to show you. And I can prove that these things work. I do it every single week. Every single week I outline these things. And if it doesn't work, it won't hold up. So right away you can read the comments in the YouTube mentorship and you can see people are really excited because they're seeing the results of simply going in and looking for the things I've outlined. I'm not giving you a lot of different things to look for. I'm giving you a very specific thing during a specific time of day. And if you focus there over a period of time, you'll start to see things that repeat over and over and over again. Now they're going to have subtle differences, but they generally have the same framework. And what do I mean by that? Well, they'll have certain signatures in price where it creates the fair value gap. And then it breaks a low, comes back up, and fills in the gap. Maybe it partially fills it, maybe it goes halfway, maybe it completely closes it in. We don't need that. We don't need to be precise. That's what I'm trying to show you here. That you don't need to be pinpoint precision accurate. You can be very, average in your entry. And as long as you're using sound money management, you can obviously ferret out setups that will yield consistency. Okay. So with all that said, now you know the real story. I'm not getting shut down. Okay. I'm not going to stop teaching. In fact, I'm probably going to now do more YouTube. How's that sound? Okay. Just to get under the skin of those that just don't like it. All right. So the dollar index is our daily chart. And I mentioned, obviously, this is, for the folks that were with me on Monday, so you're going to have to just take that in stride if you weren't part of that group. But nonetheless, the idea is that we were looking for a bullish dollar. We've been bullish on dollar for a while now. And I was mentioning that we would go for the full 100 level. We hit that. I mentioned we would go to 101. And I mentioned how we could probably draw back down in after hitting 101. That's one of our targets. And the second one was going to be 101.947. And just for clarity's sake, the other one was just short of 103, but I just rounded it to 103. I'm not calling a top here in dollar. I don't do that. I'm staying with the underlying narrative that dollar should keep getting pressed higher. This is just in my mind right now, until proven otherwise, just a retracement after hitting another premium level. Now, what changes my mind on about the dollar being bullish? If we go below these lows in here, that to me signals a potential turn or intermediate term high forming in the marketplace, and it would take a little bit of time even after that for me to change my long-term bullish stance on dollar. So what am I saying in short? Allowing for sloppy price action, as I mentioned on Monday night's commentary for the private group. I know this is going to be confusing for me. Oh, you're confusing me. Just deal with it, folks, okay? It's free. Okay. So I mentioned on Monday night that we could probably see some sloppy price action, and I'm not in a hurry to make decisions about actually going in and taking live trades again yet, because we just came off Passover. There's a lot of holiday volume, and a lot of money stays on the sidelines during that week. I know it may not seem practical to some of you, but it's true. So we have to work out that little bit of lull in the volume, and I give that a few days. In fact, it may be the rest of this week, and then maybe next week things will be a little bit clearer in terms of the price action. So higher prices on dollar, that's what I'm looking for until proven wrong. And we've obviously seen two targets here hit, the 100 level and the 101 hit rather handsomely. So I have that level highlighted here. We'll drop down into the hourly chart now. Okay, you see how we moved up in, hit the 101 level. Look what they left here. See that? See how clean that is? Price does not like to leave those types of formations in its wake. So in other words, even though we had a market drop, even though we took out a swing low, even though we had a fair value gap, even though it came up here and filled it in, look at the bodies respecting that. It's beautiful. That's beautiful price action. Yes, there's a little bit of movement above it with the wicks here, okay? But the bodies, look how it's telling the story there. That is algorithmic price action, okay? That is delivered by an algorithm. That is not buying and selling pressure, okay? That's not supply and demand. It's not harmonic. It's none of that stuff. It is the algorithm delivering price on its terms. And we as speculators have the fortunate opportunity to be participants in these opportunities when they are presented. But they're not going to be profitable because of things we learned in books. Indicators didn't drive markets higher or lower. Any retail logic did not drive markets higher or lower. These markets are going to book, print, and deliver on the basis of its algorithm. Now, either you understand that and get in line with that, or get run over. If you're winning in any school of thought, and I don't care what it is, I've done all of that stuff, okay? The only time that I can look back and see when my trades were profitable is when I was in line with what the algorithm would do anyway. Now, some of you watching, and you may be watching this as a new viewer, for some of you this may be the first viewing opportunity you had with me. And it's going to sound like this guy's talking conspiracy. Well, it's not conspiracy. It's obviously, we're running electronic markets now, and AI is driving it, and there's really nothing you can do to change it. So the only thing I can suggest to you is just investigate the things I suggest are happening in the marketplace. And I promise you, if you spend, a good month, you'll either see it. If you don't, move along. There's a lot of other people that are very friendly on YouTube. I'm not saying that they're good. I'm not trying to represent anybody saying as a good teacher, but there's other people out there that are willing to give you their time, and you go chase them. But with the dollar index, showing even the signatures that I have been showing you in the YouTube community, doesn't this low being broken here in that fair value gap hits it right there? We have another higher fair value gap. So what does that mean? It could trade up into that, but we're looking for the entry in here. And then look at that. Now, is this a 1 minute chart? No. How about a 2 minute chart? 5? No, of course not. 15 minute? Nope. It's an hourly chart. And that same fractal nature of that pattern I'm teaching you in the YouTube community, it exists here. Now, if we look at the high and the low, that whole price swing here, from that low up to this high here, that parent price swing, if you put a fib on that and find out 50% of that, it's going to put you about in this area. So I'm eyeballing it, but ultimately right below that low. Isn't it interesting? That's exactly what I was teaching you in the YouTube model. But I'm teaching you to use it on any market. Don't be on this team mentality, because I already see it brewing in the comment section. A lot of futures traders are like, yeah, ICT, I love the NASDAQ trades, and even the S&P, I love it. We're futures traders. We love what you're doing. Like, I just discovered futures trading. I did that stuff back in the 90s. 1992, I cut my teeth on all that stuff. This is applicable to Forex. It's applicable to bonds. It's applicable to futures. Okay. I have students that will swear by it working in crypto. For the folks that are asking about crypto, I am not a crypto trader. If I traded crypto, I would blow my accounts out. Okay. There you go. I'm not good at trading crypto. If I was, believe me, you'd hear about it, but I'm not. Okay. So I bloomed where I was planted. Okay. So I'm good in Forex. I'm good at futures. That's it. Okay. I don't need to be anything else. I don't need to be a jack of all trades and meet everyone's expectations. If that doesn't, tickle your fancy, I apologize. But again, back to the advice earlier, you're welcome to go see someone else if that's not what you're looking for. But it goes to about 50% of that parent price leg here from here to here. That's algorithmic. So we have a break in structure here, fair value gap here. The volume of the move is inside the bodies of the candle. See that? We always allow for some inherent price action with the wicks and the tails of the candles, but we're looking for the underlying narrative. It's likely to go back in here and fill this one single candle that created that imbalance. This candle's low, this candle's high, that small little imbalance right in here, it goes up and fills in that, spends some time there, then breaks aggressively, attacking all the stops below here, 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 fills in the gap, and it goes right below that low. Why? Because equilibrium exists between this low and this high. Why did it drop like this? Because it hit our second target of 101, and plus it's 100 points or pips above the full 100 level. Where's that? There it is. Okay, so we really stretched above it, and then we had this. Now, to me, this looks a little bit like them trying to produce this sentiment idea that the dollar has topped. I'm not convinced of that yet. Okay, It could, and I could be absolutely wrong, and these highs are maybe the ones that top the dollar. That always exists. That's where I can be wrong. I don't mind being wrong by not trying to pick tops and bottoms. I don't mind that. Okay, it doesn't make me feel inferior. It doesn't make me feel like I don't know what I'm doing. It keeps me on the right side of institutional order flow. Institutional order flow is rooted on higher time frame bias. Okay, and that being for the dollar, it's bullish. Well, it's bullish in my opinion. Let's say it that way. So while I don't subscribe to the idea that we have topped here, I like the idea that we came back down into this run, and it looks like for everyone else that may be looking for resistance ideas and a break in the market structure and a break and retest idea. I don't think it's that simple. I know some of you will argue and say, oh, it is that simple. That's fine. That's for your model. But I'm talking about calling tops and bottoms in the marketplace. That's what I'm specifically honing in on. I think that we're going to revisit that 101 level and we have unfinished business above it. That means it's likely to go a little bit higher than that. That's what I'm subscribing to right now. I'm not convinced at all that we've changed gears. Now, why am I beating this up? Because some of you didn't listen to me when I said that. Some of you didn't listen to me when I said it the second time because you have selective hearing. You're waiting for the word order block or fair value gap or breaking market structure because you came into this video with preconceived notions or expectations that I'm going to somehow qualify your analysis that you think is going to happen in Forex. So therefore, when I say these buzzwords, your ears are going to perk up and you'll be real attentive then. And then what will happen is you're going to do something in the marketplace based on that and not even listen to anything else in this video because I'm talking too much. That's going to be the excuse. But you're not listening. Okay? You have to listen and understand what I'm teaching you. That's the lecture here. Do not try to pick tops and bottoms. You don't need that. There's a lot of opportunity between intermediate term highs and lows. I don't mind missing the long-term high and the long-term low. I don't need that. I can be wrong in trades trying to be bullish on dollar. I don't trade the dollar. But if I'm bullish on dollar, that means essentially I'm what? Bearish euro, bearish British pound versus US dollar. All foreign currencies I'm bearish on and bullish on dollar. That's essentially what I'm saying here. So I don't want any of you taking what I'm saying here in one sentence or one little notation that I make reference to in a specific chart and make a sentiment idea, okay, or a justification for your trade. So be mindful of that, okay? All right, so 15-minute time frame, we finally made it. Sell side liquidity resting below these lows in here, swing low, and we had sell side resting below here as well. So as I mentioned, too clean up here. They're really building the idea that this is resistance. I don't think that's the case. And we might want to go a little bit deeper. If it retrades back, let's go back up to this here. We could trade back to the 100 level, maybe sneak below it just a little bit to make everybody think this is really done. If I was making market for $1, I would take it down below 100, dip it into 99.95 or 92 in that area here, and then start to work it higher. That's how I would do it, because it would convince everybody out there that the dollar is probably topped, and then I would take it the other direction. You know what I'm talking about. It happens most of the time in your trades. You get in and you take something, all of a sudden, it's not as bullish as I thought it was, and it went lower. I've been here, folks. I'm not making fun of you. All right, so here is that hourly fair value gap, but now look at it with the lens of the 15-minute time frame. So we have this area here, but then we have this imbalance right there. So it comes up a little bit deeper, closes that in. What do these two up close candles represent? A bearish order block. So we can use the low of the lowest up close candle and its opening price. You draw that out in time, hammered it. Why is this an order block? Well, it's because it's where price was delivered on the upside, even though it's indecisive candles here. That up close, right before this displacement to the downside, it's not, listen to me folks, it's not what these folks are taking from my videos and writing books on Amazon. Completely wrong. And there's a lot of things I'm going to keep from even my private mentorship group about order block theory until my books are released. Okay, and I've purposely held that back. Why is he holding? You know what I'm talking about. It happens most of the time in your trades. You get in and you take something, all of a sudden, it's not as bullish as I thought it was, and it went lower. I've been here, folks. I'm not making fun of you. All right, so here is that hourly fair value gap, but now look at it with the lens of the 15-minute time frame. So we have this area here, but then we have this imbalance right there. So it comes up a little bit deeper, closes that in. What do these two up close candles represent? A bearish order block. So we can use the low of the lowest up close candle and its opening price. You draw that out in time, hammered it. Why is this an order block? Well, it's because it's where price was delivered on the upside, even though it's indecisive candles here. That up close, right before this displacement to the downside, it's not, listen to me folks, it's not what these folks are taking from my videos and writing books on Amazon. Completely wrong. And there's a lot of things I'm going to keep from even my private mentorship group about order block theory until my books are released. Okay, and I've purposely held that back. Why is he holding back everything? It's because I have 4 books coming. One's a fiction, and 3 are technical. Okay, so I'm going to put there have falsely stated that they created this or I copied it for something, and you don't know anything about order blocks. Okay, trust me, you don't know anything about it, but you know enough to find something that repeats over and over again. In the second book in my trilogy I'm writing, when's it coming out? You'll know more about that as I come. It's a whole pandemic thing messed up the delivery schedule I had for them, but the second volume in that trilogy, I'm going to divulge a lot about order blocks. So that way the world, the community in trading will know it's mine and you'll know more about it there. So anything that happens after the fact, I'm going to correct a lot of people that think they know about order blocks because they're actually harming people that pay them or listen to them. And it's not true. So really what you're saying is the stuff that goes along with supply and demand, and I'm not supply and demand. But why are these candles here on order block? It's because we had to change in the state of delivery where it's already dropping, then it goes higher. So the algorithm is putting it's kind of like a bookmark. Okay, this is where it will want to refer back to in the future. Okay, think of it like that. So, like say you're reading a book, okay, and you're in this chapter, and all of a sudden, real life kicks in, you gotta go back to work. Or you Can't read anymore because your spouse says, you need to do something around the house. Hint, hint, nudge, nudge. So you have to stop reading. You put your little bookmark in the page where you're at, okay? And then you come back to it later on. Well, when you stop reading, that's essentially where this candle closes. And then we come back to the book. Here, you pick up with the storyline. And what was the storyline? It was dropping. It just had a little pause in here, and then we go right back to the storyline. So maybe that analogy doesn't fit you, but it makes sense a lot of ways to me, okay? It's like a reference point that the algorithm will go back to this. The algorithm doesn't know where your specific stop is at all times. Your broker does. But the algorithm doesn't necessarily know where your stop is or my stop is at any given time. But it's based on the logic that is really promoted and regurgitated all the time in books and seminars and course teachers and things. Put your stop rate above the high. Put your stop rate above the highs. It's always the same thing all the time. And it doesn't take, rocket scientists to sit down on a chart and say, yeah, well, if it's been dropping, find a short-term high most recently, and that's where right above that, there's going to be buy stops. For anyone that's short, they trail their stop loss down. So what does that mean? It's like anyone that went short up here and was fortunate to be right, and it does this move here and starts to break down, their stop would be moved from here to right above this short-term high. That trailing stop loss mentality, okay? I'm not a real big fan of rushing my stop, and that's why I teach the way I teach, because I'm looking for things that make sense, and I'm not trying to strangle the marketplace. But this order block here is a change in the state of delivery. It's been going lower. It's likely to go lower. This displacement qualifies that order block because it creates a fair value gap, and the narrative is likely to go lower. Now, this lower movement is short-term in nature. It's counter long-term bias, okay? You can and will absolutely lose money trading this style of trading because you're going against the higher time frame order flow. This type of trading, if you go in and you're trying to be very nimble, trying to go in and think you can swing up and down, buy, sell, and you just recently started, you're going to absolutely blow your account. Okay, that is exactly what's going to happen, so don't do this. So why am I teaching this? So that way you don't do it. Understand that this is all part of a natural retracement, and you can trust and study and backtest all the things that I've been teaching you, and they exist even in these moves here. But you may not, and don't be offended by this, you may not have the skill set to see this type of retracement lower and short it. That's okay. You don't need to have that skill set. I have students that are really good with trading contrarian setups like this that don't trust bias because they think the moment they get in, it's going to turn on them. So they like to take contrarian trades where they trust it more because it just makes sense for it to be broken, if that makes any sense. In other words, they know that this possibly may keep going higher because they hear me saying it. But that doesn't change their convictions about being a contrarian. And in some ways, they're going against what I'm saying is a higher time frame order flow bias. But they know how to pick these opportunities where there is confirmation that's not likely to continue at that very moment. So therefore, they'll go in and go against that bias and take trades. Now, is that wrong? No, because it matches their personality and they know where those opportunities exist. Do I think that all traders should go in with that expectation and that mode of study? Absolutely not. No way, absolutely no way. Because if that's what you really are internally as a trader, it'll materialize and manifest itself over time. But the only way you're going to know that is by learning the way I'm teaching it, because I'm teaching you how to trust the higher time frame bias. Okay, I'm not teaching the trend is your friend, because the things that they're using to promote those ideas, I don't subscribe to. So since I don't subscribe to those views, I don't look at it that way. So I'm looking at how the market moves from discount to premium, premium to discount, and also within market structure. So some of you at times will point and say, it looks like this, or it looks like that over here. It's only momentary familiarity. It looks familiar, but it's not. There's a whole lot of other things going on that just sometimes look very similar to certain things. But there's a specific criteria that takes place that I'm looking for, that I teach my students, and you've learned a very simple approach to that that's existing right here in this chart, in the YouTube model. All right, so Eurodollar daily chart. All right, so it's been a while since I've talked to the YouTube community. I think it's been like 2 weeks or so, isn't it? Something to that effect. But I drove your attention to that low. I said we were aiming for that, and as luck would have it, look, it went down there. So that is an example of bias. That's an example of what I've actually talked to my community about for, well, weeks as it was starting to come down. We were up here looking for it to come down to that low. I mentioned this low here, I mentioned these lows here, and this low there. And you all on YouTube knew that we were looking for this run on Euro. The problem, and this is why I'm not trading Forex at the moment, okay? No, Forex is not broken. No, I don't think they're ever going to change the algorithm. No, I don't think that they're going to change their algorithm or go against the things I'm teaching, because the way I'm teaching is the market itself. It's the internal engines that make these price deliveries appear on your chart, okay? That's why I'm teaching it and with no real reservations, because I know me teaching this isn't going to change anything. The level of trades that are being pushed through these markets is not going to be changed by you watching these videos, because honestly, I've taught for years, and there's a lot of people that just simply cannot follow instructions. They can't follow rules, and they want to fault somebody else. They want to fault this one over here. They want to fault me. They want to fault the concepts, when there's people already out there proving just from the free stuff that they're passing competitions and challenges and making money in their own accounts. You're doing very well in demo. They all have a wide range of experiences already, and I've only started the last week or so in January. So this business is very personal, and it's going to reveal a lot of things about you, and you're going to see things that you didn't recognize before, and sometimes it's going to be ugly. You're not as good as you thought you were. You're not as astute as you thought you were. You're not as responsible as you thought you were. Believe me, I learned those lessons in the 90s, and it was not fun, and you resist it. And the folks that resist it will never get it. And they'll never learn how to trade properly from anyone else because they have a deep-rooted issue within themselves. So it won't make a difference if somebody else steps in and says, hey, I got something that's going to do it for you. ICT complicates things. I'm going to give you this thing here. You push a button and it gets you in. No, the same underlying issues that are plaguing the individual will manifest in any trading approach because they lack responsibility, number one. They lack the adherence to rules, and they have not put enough time. If you're not getting instant gratification, you're done. That's what the main critical thing about me is, because I'm lecturing, I'm teaching you what you're going to encounter. You may not feel this is applicable to you, but I guarantee you stay long enough in this, you're going to be met with this. And if I don't tell you how to deal with it, overcome it, or think about how you should be overcoming it when you get to that bridge, okay, because you're all going to get to it eventually. Different times, different people, everyone grows differently. But you're going to have these crossroads where you come to where you feel like, I don't think I should be doing this anymore. I think I should be doing that. Or the grass looks greener on that over here. Or this person made money over here and I haven't made money this week. So maybe my stuff's broken. Let me go ahead and look at this. That's nonsense. There's people out there that don't trade like me and they make millions because they are good money managers. Period. That's it. They have something that gives them a decision-making process. They call it their system, okay, or their edge. But really, they're just good money managers. Period. They have something that instigates the idea of a transaction in the marketplace. They have a faith-based system in believing that as long as it doesn't do this, go down to a level where they will stop, they'll stay with that idea. And then when it gets to another level, they get out. That's trading, okay? But the idea is, I don't think that profitable systems outside of what I'm teaching are linked to their actual system. It's linked to their adherence to their rules, sound money management, and not over trading and not over leveraging. Because literally, I could flip a quarter, and you could too. With sound money management, you could make an account be profitable. Now that sounds crazy, okay? Do it with a demo. That's what I'm suggesting to you here. Flip a quarter. If it's heads, you buy. Flip a quarter. If it's tails, you sell short. Do it every single day. Don't risk more than 0.5%. Aim for 1%, and do that. Buy the open, sell the open. That's it. That's all you do. Use a 30 pip stop and trade a forex pair and do it. Okay, and just test the idea and see how hard it is to blow the account. It takes a lot of effort to blow that account, but over time you can see that it can show profitability. Now, if you take that application and apply it to, okay, what happens if you limit your number of trades? If you remove the frequency at which you trade intra-week, that means what days of the week you're actually going to specifically trade on. And then within those days, what specific time of that day are you going to trade on? And then what asset classes are you going to trade? And inside that asset class, what specific market are you going to trade? And inside that specific market, are you going to be bullish or going to be bearish? So you're refining everything down to an algorithm or a recipe, because a recipe is an algorithm. Okay, you have this list of ingredients, and you put these ingredients, combine them in a specific order, and at the end, you should have an expected result being a cake or a cookie or whatever it is that your mother or grandma used to make for you. Bottom line is, I'm giving you recipes. Now, it's up to you to decide on what you're going to do with this information. I show it, as you see every single week in my mentorship group. I talk about where the market's going to go beforehand. I'm not telling you to buy or sell short anything at any one particular level. I'm pointing to where the market's going to go because I've already taught you entry strategies, but I'm not trying to force a specific entry strategy on any one student or all of you collectively, because there is no pressing all of you into a mold, because that will absolutely guarantee failure as a mentor, and it'd be failure for a community of students. I'm cognizant that there is a wide disparity between my personality and everyone else's, and just as well as if we were all in a room, we would all have different personalities as well. That's going to be an issue for all of you. So my teaching style allows for you to find your own style in the tools and concepts that I teach. Now, I could trade with every single one of them, and my better students can do it with a good list of them. But I don't have one student out there that can do everything well, perfectly. I haven't had that yet. I like to believe before I pass on, I will, but I don't have that yet. But I do have some extremely good traders, some consistently good, profitable traders. But I also have failures. These folks just simply can't get it. Now, in the YouTube community, give it time. You're gonna see people commenting that they can't do it. Okay, my encouragement to all of you is the same thing I'm going to tell you that I tell my private group in their forum. Do not gang up on them. Don't make fun of them. Don't say, oh well, this, that, and other thing. Be encouraging to them, because really, if they're posting that, they're hurting. They feel frustrated, and they're basically saying, unless someone intervenes right now, I'm going to quit. And I have done that. There's been nobody to tell me keep going. Okay, back in the 90s, I just had to persevere. I'm hoping by me showing these things publicly, talking about what's going to happen, where it's going to go, it proves to you that it's possible to forecast these price moves. Now, what you do is you go back inside all the moves here and decipher what it is I'm pointing to and why it was useful for you to find a setup in it, and does that setup repeat enough for you to justify that specific way or approach of trading? What do I mean by that? Some of my students can't day trade. They just don't have the ability to do it. They have businesses or school, or they have jobs, and they have to be making ends meet. They're elsewhere. They can't be in front of the charts. So they have to position trade. So that means they're going to have to trade on a daily chart or a 4-hour chart. And that's fine. You can do that. It just takes a lot of time to move from these levels here down to here. And you got to wait a long time for the next new setup. I'm not a fan of that. Yeah. But I'm not trying to discourage anybody that has to operate under those restraints. But I mentioned on the YouTube community in the mentorship videos for this channel, I mentioned that we were going to be aiming for that low. We got that. It's sloppy on its delivery, but it got down there. Back to why I'm not touching Forex. It's because of this type of movement here. Everything is really muddy right now. The reason why currencies are not moving well is because trade is being hindered. There is a supply chain congestion. All these factors are causing currencies not to move. If you look around, everybody that has been in this business for a long time, that's consistently trading, profitable, they're noteworthy, they're kind of like the pillars of the trading community, none of them are really talking about currencies right now because it's a quiet asset class. It's asleep right now. I don't think it's going to stay this way forever. Okay, and when it springs back to life, everybody's going to want to go back into currencies. Okay, but right now it's a really slow market, and it's really hard for a trader to learn in this environment because you want to see excitement, you want to see animation in the price action, and I get it. That's what we want as traders. So what I've done, and I do this in my own analysis, studies, and teachings and tradings, and the way I teach my private group too. They'll test for it in the comment section. You tell me I'm a liar, okay? If I'm not doing this every week with y'all, every month, every year. I navigate the marketplace. So I'm taking their attention to where the markets are going to be big movers. Where's the excitement? And I do that beforehand. I'm not waiting for something to happen. Oh, let's go over here now. It's exciting. No, I'm always before the big moves start coming. Forex is not it right now. Okay. Index futures has been. Now we're also entering a period where it could get a little dry. May typically can create some scenario where it's bearish. I'm looking for evidence that's going to continue, but we'll get into that when we talk about index futures. But euro dollar delivered as we were expecting, got the lower prices, and that same movement and idea of reaching for that low here is basically what I'm going to be doing with the live streams, but just with intraday charts. Okay, so in other words, what do I promise to do with all of you in the few times in May that I'm going to do the live streams? I'm basically going to outline where I think the draw on liquidity is. Now, what is that? The draw on liquidity was below this low here. All this movement here, each candle going lower. Each day it went down, even though it made a low here on this candle and a low on this candle and a low here, even this candle being up close and this candle not quite yet making that low. But then one day we smashed down through it and we dug in a little deeper one more time, not deeper than that low, but deeper below that low on a daily basis. You had 1, 2, 3, 4, 5 days below that old low, and we came back up in. I'm going to basically point to where I think intraday price action is going to go. Now, I don't want any of you to take that as an invitation to go and trade on that. That's the worst thing you can do. Not because I suck, not because I can't trade, not because I'm not good at analysis, because I don't want you to do that yet. I'm forcing you to study price action. You have to learn how to tape read. If you can't tape read, you will not be consistent in your trading. Period. End of story. That's the way it is. Because everything that you'll be doing if you make money is really not based on the market. It's based on circumstance. And believe me, I've had periods of being profitable with just dumb luck. It happened, folks. In the 90s, I really thought when I first started that, wow, I read a book, and I watched a couple of videos, and wow, this stuff really works. And what I was really doing was just buying a perpetual bull market, and everything was going up. I could throw a dart at the wall, and whatever it hit, I was buying that, and it made money. Everything was going up. So it tricked me into thinking I knew what I was doing at the time, and I didn't. So I want you to take the live streams I do in May, and sometimes it'll be Forex, majority of the time it's going to be futures. Don't be part of that team mentality. Futures is the better thing, Forex is the better thing. It's just right now, futures. Yeah, I have a vested interest in proving to the YouTube community that, number one, I know those markets better, actually, than Forex. I started in futures in 1992. The same things that I always answer everyone. Okay, let's say if you're wrong, ICT. Okay, I understand. I ask you all the time in the comment section, what happens if you teach this to so many people? Will the algorithm be changed? Will they change the way it is? Will they go after people that use this? Blah, blah, blah. I don't believe that's the case. But let's go out on a limb and say ICT is wrong. Okay, say that the whole world goes to one currency, okay, and everything goes upside down and Forex no longer is there. What would I do? Well, if I was here, I would go back to trading futures, period. So I don't want you to think that Team Futures is better than Team Forex, because believe me, when Forex comes back to life, it's going to smoke index futures, and it's going to be all kinds of excitement back in currencies, okay? That's the way it is, folks. It moves in and out of, asset classes are really, really hot, and then they go cold, and something else gets really exciting. It's this navigation through the asset classes that experience, and those with experience doing it, know how to do. 30 years, I've been doing this stuff. 30 years. And those 30 years, the greatest lessons I learned was what I'm suggesting and talking about right now. To some of you young guys, okay, it's just too much talking. But these are the things that you need to understand, because they're going to be the impediments to you succeeding. Because you think every day there's going to be a big move in the euro because you see something. Just because you think you see something doesn't mean that market's going to do anything. Look how consolidated it was for this day, here, 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 and here. Then finally it just whips down below that low. That can be very frustrating for someone that has been expecting this thing to go down. And for instance, look at the folks that have been trying to break out, go short below that low here. It does so here and then comes breaking right back up in the same day. And that might have changed their opinion about the market going lower. But I teach that liquidity below that low is where it's really going to go. So these up close candles really are just opportunities to go short and then drive it lower. Okay, so I'll talk a little bit more about the live streams when we get to the evening S&P part. All right, so admittedly, this video is a lot more talking than I normally do. It's because I'm conscious that there are two communities here. So I'm having conversations with both of you. Now, to me, it's normal. I can do these kind of things. I can go back and forth and start a conversation, leave it, and do some other things and come back and fill in the gaps I wanted to talk about. But I know this is the type of video that's going to drive most of you that are really, really critical. It's going to drive you nuts. But I promise you, if you listen to me, there's some really good stuff in this video. So just take what you can find useful, and what you don't find useful, just filter out. So here's the hourly chart on euro. Market traded down aggressively here on this day. Swept below that low. Here's that daily low. I'm going to go back at me because I'm not talking, probably didn't make note of it. That daily low is 1.0806, and one to that. That's that line right here, okay? So an hourly chart, it breaks down, slams below it, and then look at all this price action in here. See all that? This is during Passover week, last week when I wasn't trading, and we hit that same low here. We rally, create a fair value gap there, run right back up to that old highs in here. And optimal trade entry. From the high to the low, we went right up into a short-term premium. So as a short-term trader, going counter-trend, remember I was referring to in the dollar index where I have students that are contrarian. If I'm long-term bullish on dollar, they know where to go in and pick their shots where it looks like retail will see it as a reversal, and that's how they made their model. So I'm bullish on dollar. They'll wait for retail to think that that bullish dollar has topped, and then they'll go in and find their setups. So hopefully that made it more clear about what I was saying earlier. Well, what would that look like with euro? Well, it would look like this. We have a run back down into old support, which is old daily low, rallies, creates a fair value gap, buy it in here, and right back above the bodies of these candles into the 62% tracing level, because 62 and 79% tracing level are what I teach as optimal trade entry range, but it's not optimal trade entry for the setup. Okay, so in other words, we could be a buyer down here and trade back up to the 62% tracing level, or the bodies, okay, right above the bodies of these candles here. Just take the 62% tracing level and just make it real easy for yourself. But that would be a nice little run in here. It's not a lot of pips. I mean, what is it, 20? 60 to 50, it's 10, 20, 30-ish, 30, 40 pips, thereabouts. Not bad, it's a bread and butter type setup, but that would be the version of a contrarian trade against the bias that I'm suggesting to my private group, which has also been shown to you in the YouTube community, being bearish on euro until we got below that low here. Now for the YouTube community, you're all scratching like, okay, get to the point where it's going to go. Where's it going to go next? Okay, this is what I mentioned on Monday to my private group. Now I'm telling you now, just because we're doing this style of teaching tonight, because I don't have time to do multiple copies of the same video in my private group, then make a YouTube video. So what I'm choosing to do is make a very, very long, irritating video that has a lot of information in it for YouTube. So I don't have a bias at the very moment for Euro. I don't have a clean level. It's going to go to and then reverse. Okay, I've been specific recently, and you both communities have known that. But right now, we're back in that sideways consolidation congestion area, and we have to wait for displacement. And what does that mean? Wait for something like this. Okay, if we get on the outside, okay, great, that's fine. It'll give us something to work with in terms of a range. If it breaks lower, that's fine. It'll give us something to work with in terms of a range as well. What do I mean by that? Well, from this high to that low, we went below these lows in here, and then we created a short-term break in market structure here. So this low, broken, came back down in, filled the fair value gap, spent some time in here, a lot of time. Okay, this is typical with a holiday. And then starting into a new week, it's slow volume, and then we get this little bit of movement, and then we pump right back up into this range, high and low. 50% of it's like right here. Above 50%, we're going to be looking for a premium. So 62 to 79% traction level, that would be our objective. So if we get a displacement lower, I'm going to look for this type of move here, this repeated later on. Vice versa, if it goes higher, I don't care at this point because it hit my objective. My objective was I want to see Euro go below that low. Okay, this level here on the daily chart. Since it's done that, and I am neutral near term on dollar, I'm still long term bullish. But right now, I don't see a setup to go in and say, okay, now there's something to do. Now, for new traders or new students here, that doesn't sound feasible. You just said you've been doing this for 30 years. You can't find a trade right now, not on the daily chart, not on the 4-hour chart, and not on the hourly. At the very moment, at the time of this recording, the way the charts are laid out in front of me, I have nothing to go on at the very moment. That's also another reason why I wanted to do this, because I can't really tick off the private community because I'm not really giving this YouTube channel the prognostication I usually give them. But I'm teaching and lecturing, and I'm giving it kind of like a compare and contrast of what they're getting versus what you all get. And neither one of you should be fighting with one another or jealous of one another, okay? Because you all had opportunity to join, and no one's allowed to do it anymore. So let's go on to Euro dollar, 15-minute time frame, and you can see here again, really nice fair value gap. This is what I was referring to on the hourly chart. It's just really clean here on the 15-minute. Now, when I say clean, what do I mean by that? We have a nice run up here. It returns back to that old daily low, and then we have what? Displacement. That real energetic run higher. That is algorithmic. When it creates this gap here, we don't care that it's still stretching up here. Now, as a new trader, or someone that is impatient, that doesn't have an understanding of what they're looking for, it will feel like an impossibility for them to say, I'll wait till it gets back down here and then buy. Because what will happen is once it does, when it trades down like this, they're not going to look at that and say, oh yeah, I feel good about that. They're going to think, man, this thing, what happens if it's going down below these equal lows? Because that's what everybody on YouTube is now teaching because I mentioned it. No. What's the narrative? We're short term, right now, oversold on the daily. Why? Because we took out that old daily low. We went below it. So now it's taken what out of the marketplace? Sell stops or sell side liquidity. So what's the market going to look for now? Buy side liquidity. That means it's got to go higher to get that. So energetic move off that same daily low, and it creates that displacement. When it trades back down into that, I'm thinking, okay, well, it's created this short-term high. It's going to want to run back up into that. But even if it doesn't, if I just get above the bodies of these candles in here and reach up into that 62% traction level on the hourly chart, as I mentioned right before I transition to the 15-minute time frame, we reached up into that 62% traction level. So that would be an opportunity to be a buyer here and sell short, not sell short, but sell your long there and be done. And there's about 30 pips or so. That is a bread and butter trade. Now, that is not a style of trade that I would recommend you as a new developing student because it's going against the order flow. These are types of moves that you want to go back and back test. And because you're doing that, what will happen is over months and years, oh, here we go. He's kicking the can down the road, justifying why his concepts don't work because I can't make them work. That means I didn't spend enough time. That's his excuse. No, it's the truth. You are going to look for a setup if you watch a video one time. And you're going to expect it to work every single day between 8:30 in the morning and 11 o'clock. And because you see what looks like a fair value gap, your bias is going to be wrong, or your expectation on the daily candle itself, the individual daily candle, which I'll talk about and teach later on this video. Yes, it's an impactful video tonight. It may be boring, but I got a lot of stuff in this one. You're going to do something incorrectly because you're in a rush, because you want to feel like you have to know right away it works for you. And there is no right away in trading except for blowing your account. Because if you don't know what you're doing, right away, you're going to blow your account. Okay, that's what's going to happen. So I talk and I teach like this so that way you know you have been fortified with all these things in advance. What to look out for, what not to fall victim to, how to think about it in mental perspective on what you're doing as a trader and what the market should be doing. They have to be in agreement. And it takes time for that to happen. It doesn't happen by watching a video. It doesn't happen in 40 days. Okay, it doesn't happen in 120 days. It doesn't happen in the first year. It takes a little bit of time. So there's a lot of fumbling that you're going to have to do that figure out what you are looking for. Because right now, if you're just starting, I'm promising you right now, you have no idea what you want to do. And you're probably not realizing that what you're going to evolve into, the end results of a speculator, what you're doing as a trading model, how you're trading the markets, you don't even know what that is yet. That's a gradual thing that it becomes, well, obvious to someone that has taken this on as a business. Not, I'm going to school. I'm treating this like a college degree. Well, that's good when you first start, but you need to treat this like a business. Are you going to open up a business and just not worry about it every day? You're going to be worrying about it every day. And you can put all your time and effort into it. That's how you should treat this. Every day, whether the transactions that you make are profitable or not, they're all learning experiences. So that's why backtesting is important, keeping trade journal is important, annotating your charts, and referring back to how it worked off of that daily chart, which is what I'll talk about tonight also. All right, finally at the bearish count. I'm going to go through this one pretty quick because I already spent a lot of time talking. All right, so we had a little bit of fair value gap here. Rally up in that, mentioned we were going to go below that low. We did, and as I mentioned on Monday, we would have a consolidation type, sloppy type price action environment. We're not yet out of the holiday doldrum. Last week, a lot of money was on the sidelines, so we're waiting for the smart money to put things in motion, and then it'll give us another bias as to what we're looking for. I'm maintaining a bearish stance on British pound versus US dollar because I have a long-term bullish stance on dollar. So everything I think eventually will bend the knee and go lower, like euro, pound, Aussie, all these currencies should go lower. If I'm wrong, it'll trade above the fair value gap. If it does, I'm wrong. As long as we're below the fair value gap here, I'm bearish on cable. And for new people, cable is pound versus dollar, just a nickname for it. All right, so here is the hourly chart. I'm just going to get very simple, sweet, to the point. There's nothing here, absolutely zero, nothing in this chart. Nothing to trade on. Not one thing. I can't look at this and say, oh, I got to stop here, or I can do that. There's nothing. Okay, nothing here at all. Take a deep breath and hear that again. there's nothing on this chart that's noteworthy. Now think about that. Does it feel comfortable? For some of you, it doesn't feel comfortable. It's like, what? There's nothing here. That's the difference between what I mentioned when I was looking at the 15-minute time frame on Euro. I said how nice and clean it was. There's nothing clean in this price action. It's all back and forth, back and forth. It's sloppy price action. Okay, when I say things are sloppy, this is it. There's nothing that you can very easily pick out as, okay, it's bullish, it's going to pull down to a specific level, and I expect it to rally from there. I don't have any of that here. Nothing's in this chart that's noteworthy or what I would ever put money behind. So when it looks like this, we roll on. Here is the 15-minute time frame. Sloppy. Nothing here. So when you go through your charts, if the marketplace that you're looking at creates these scenarios where it's just really messy, what's the first thing you should consider? Closing the charts, turning your computer off, and go do something you love to do. Spend time with your family, with friends, and hobby chasing, whatever it is you're doing otherwise outside of the markets, which is all of you should have a hobby outside of this, not just watch my videos or someone else's stuff. Have something you do outside of trading because you have to have an outlet, and otherwise you're going to burn out. But when the markets look like this, you don't touch them. I'm not talking about, my community knows that I have not been really, and it breaks my heart because this has always been my favorite pair, but I have not been touching British pound for a long time. Months have gone by. I have not done one trade in this currency pair because it's just simply not delivering what I'm looking for. Now, some of you are thinking, oh, there's proof right there. They're changing the algo. No, it's just a mess right now. The whole world's all messed up, and trade is being affected by that. So it's going to show its hand and manifest itself in the currencies. And this is what you have. Trust me, folks, in the offing, just over the horizon, there's something about to happen. And when that happens, these markets are going to get real excited. And they're going to be moving around a lot. And everybody's going to be like, man, I'm going to go and trade Forex. Trust me, that day's coming. What day is it exactly? I don't know. But I'm being patient until it manifests itself. When it does, you're going to know it. Everybody's going to know. But when it creates that, man, it's going to be what I call salad days. It just means easy trading. So don't get bummed out by looking at this and thinking, oh, this is actually a good thing, because it teaches you when not to be doing anything. When it feels alien, it feels counterintuitive or counterproductive or the opposite of what you're in here learning about. You're thinking, I'm learning how to do this, so I should go to the chart and go and find a setup. Yes, that's reasonable for a neophyte, but you want to learn how to do this profitably, right? I mean, I would hope you would want that. You want to do things consistently, right? Hopefully that's what you're trying to do. I'm trying to promote that in you. Maybe that's not what you thought about when you first started, but you want to be able to know why you're doing something and when not to do it. Knowing when not to do something is crucial because it'll keep you from blowing your account. It'll keep you from being undisciplined, and it'll give you peace of mind. It'll remove that fear of missing out. I don't have any fear of missing any of this price action here. I'm not losing any sleep over it. And you shouldn't either. And when your market, whatever that market is performing like this, just leave it alone. Take a break. You don't need to trade today. You don't need to trade tomorrow. If you feel that, understand this and listen, okay? Put the potato chips down, put your drink down, listen. You do not need to trade every single day. Despite what you're thinking and feeling, you don't. What you need to do is understand why today or tomorrow is a day that's highly probable that your bias will deliver to a target you already know is likely to be traded to. And I'll talk about that later in the video. But you have to have an expectation of where it's going to go. Where's it going next, higher or lower? If you can't reasonably outline that, then you're gambling. And if you're trying to trade every day, or you have this impulse that you have to be trading, you have to be in there, you have to be doing it, that's a gambler's mentality. I do not promote gamblers. I do not promote gambling. I do not promote over-leveraging. I do not promote lucky over-leveraged trading. I promote one contract, work on trying to double your account. How long does it take? I don't know. How long is it going to take you? I don't know. But that should be your goal. Work with the lowest leverage and try to double your account. If you don't have the patience to do that, you're a gambler. You're trying to rush to make big money. And there's only one end result that comes from that. You blow your account. I'm telling you, folks, if you don't believe me, watch when you try to do it. And you're going to be coming back and saying in the comment section, you were right, I wish I would have listened. And then the true test is, will you repeat the same error, thinking you just weren't schooled enough yet? Okay, you have the skill set yet. Now you do, because you watched 2 more videos. And then you do it again. And then you write in the comment section, I just blew my account because I didn't do this and I didn't do that. What's wrong with me? I'm telling you what's wrong with you. You're rushing and you're gambling. And I don't teach that. So you're doing what? Everything I'm telling you not to do. So are you really ready to be taught? No. Once you break yourself and you have no more money in your account, and you have no more money put back in the account, and you are questioning whether or not trading is for you, that is the student that's ready, because they have nothing to go in and gamble with, and it's all up from there. Or they say, trading's not for me. And guess what? That's the right decision, because you know yourself better than anyone else. If you decide that, you know what, I've tried this, I've tried that, it isn't working, trading's not for me, well, God bless you. You've probably saved yourself a fortune, because there's a lot of people that this will never work for, because they are not disciplined. They're not responsible. They're not going to follow the rules, and they're not going to do things as they were taught. And they'll find fault with everything but themselves. And that is mental illness. I experienced it. I know it firsthand, and it's painful. It's embarrassing. It is deflating. It feels horrible, but it's not permanent. It's absolutely corrected by certain things and skill sets replacing bad habits. That's all. But it takes responsible discipline and a routine and adhering to it and being accountable to someone. Who is that? Someone you trust. Say, look, this is how I'm going to be doing my studies and my trading. I just want to show you what I'm doing. And it's better if you're in a community that is like-minded. And that's what I try to foster. I try to create that. And unfortunately, what happens is there's people on the outside that usually take shots at me or think this or that about what I do, what I teach, or my students. And they'll say it's a cult. When all I'm trying to do is empower that individual to be an independent thinker. I don't want you to believe me or anything I'm saying. I want you to go in, look at these markets with the lens I'm providing you. If I'm a fraud and these don't work, you're going to know right away. If you're really putting effort in, you're going to know right away if these things are valid or not. But for those that have done the work, nobody's convincing them otherwise now that it absolutely is the truth. And it's consistent. But when I say consistent, that's not the same thing as it happens every single day in the same pair. If you look at, like, for instance, none of the things I'm teaching are existing in this pair right now. That's why my private group and none of you have seen anything with this pair from me for a long, long time, because it's not showing clear, clean price action. So since it's not doing it, I take my hand off of it and my attention goes elsewhere. Where has it been diverted to? Index futures. Index futures will have this type of price action soon. Does it mean that index futures trading is dead? No. Does it mean the algorithm has stopped working? No. It just means that it's being heavily manipulated. So what does that mean for you internally? Don't touch it. This is a rattlesnake. If you see a rattlesnake on a trail, you're walking down there and you hear that rattle, I've never seen a rattlesnake live in front of me, okay? But I'm telling you what, I'd recognize it if it started rattling. And I'm going to stand still. And I'm going to look around and find it. And wherever it is, I'm backing away from it. Simple. Well, I treat these times in the marketplace just like that. Because there were times where I looked at this and said, I'm better than the average bear. I'll get in here and find the honey. Well, there you go. I got stung. That's why I'm talking to you like this, folks. You gave me your time. You gave me your ear. And you're giving me your trust. I'm giving you the best advice anybody could ever give you. Don't discount it as just talking, droning on, pontification. No. This is real insight, folks. It's 3 decades of it. I lost a lot of money not doing what I'm teaching you to do. Like, I'm teaching you the very things I fell victim to and how to avoid it. Wouldn't you want to do that? I mean, I would literally give everything I had back in 1992 if I had someone like I'm trying to be for all of you. I'm trying to be that person that has real world experience, that knows what's going on, proves it, and I'm trying to show you, lower your expectations on yourself. Don't try to be an Olympic trader, okay? You don't need to be Olympic. Just be consistent. If you find a bread and butter setup once a week, you can do a lot with that. It just takes consistency and money management. The money management does the heavy lifting. The hardest thing is finding something you're going to trust and stay with. And when it doesn't deliver, or when you can't find it in your market, it doesn't change it. It just means you stand still. That's it. And it's hard. It's real hard, because what happens if you go 2 weeks without taking a trade? What's it going to do for your mindset? For some of you, it's going to drive you nuts. Others, it's going to make you want to change the style of trading. And they're both wrong. The 30 years taught me that. Books didn't teach me that. Books talked about system hopping, but you don't really know that lesson until you blow accounts, do dozens of different trading styles and approaches that don't work. They have no sound logic in the marketplace. Why it's doing this and doing that, divergence, indicator this, harmonic that. All those things are something that promotes the idea of a religious view on the marketplace and not just time and price. Time and price is not a religion. It's the truth. That's what these markets deliver on. Look at the chart. What's at the bottom of the chart? Time. What's on the vertical axis? Price. Why are you complicating it? You're saying I'm complicating it. Why are you? You're adding triangles and shapes and all these things and moving averages and all this stuff on your chart instead of just looking at what these candlesticks are documenting. Where was it an hour ago? Where was it last Friday? Where's it likely to go today? Where's it likely to go by the end of the week? If you ask those questions every single time you sit in front of the charts, you'll have a pretty good idea what it's likely to do. Will it happen every single time? No. But by itself, that right there, what is this mentioned to you? That was the first steps for me to stop looking at those books. Those books are going to tell you things that 90% of people that trade lose money on. Let's be honest, folks. Let's just call it like it is, okay? All of those books, all of those teachers, all these YouTube channels, everybody out there is talking about the same things that result in the 90% blowout of live traders. So why are you holding on to that stuff with a death grip? No. It's going to work for me. I did that same thing. And I lost. Blew accounts over and over again. Crying, tears, weeping. Why can't I figure it out? Those things are in a 90% bracket of losing money. If you walk down the road and you see these glasses of water, free to drink, you walk over to it, you pick it up, you sniff it, just doesn't feel right. And you take a step back and you watch other people walk over and as soon as they take a drink, you start choking and drop dead right there. How many people do you need to see pick up that glass, take a drink, and drop dead before you realize it's probably not a good idea for you to have a swig? But unfortunately, marketing is what it is, okay? There's always some clever little way, gimmicks is what they are, of making it seem like there's this new twist on something old, okay? And bad logic, no matter how much lipstick you put on it, it's still bad logic. And you can't change that. So the idea is for you to find it in the price action. The things you're looking for in the chart or in price action, they must appear clearly in price. And if it's not clear, if it's real muddy and just choppy like this, it's indicating to you that this is not a market. The smart money's going to sit down and say, yeah, this is where we're going to operate today. It's heavily manipulated. It's not being allowed to trade freely. It's held. So if it's being held and manipulated, do you want to be in there? Because if you are doing that, you're gambling. So don't do that. All right, so we made it to the futures portion of this long-winded video about nonsense, right? All right, so daily chart on the E-mini S&P. All right, so we have the market trading down into a very, very deep discount. If you look at the range low here, why am I not picking this one here? Because this move started there. Okay, that's what I'm looking at, this move. These are relatively equal lows, so I'm just going to move over to the most recent swing low. Why is this swing low? It came to the left of it, it has a higher low than this one, and it came to the right of it, has a higher low than that one. So that swing low, that one here to here, that's my daily dealing range. Okay, the market has recently retraced back down in about 50% equilibrium with that price move. Okay, so that's what we're annotating here, about halfway is what really essentially is being shown. And also, because of that, the market is likely to create a little bit of a retracement. Now, on this video, I did a teaching called Purge and Revert. Okay, and I'm going to talk a little bit about that tonight and how it's a little somewhat of a variation on that idea and premise. But I want you to think about how the market created this low here, and then the reaction and price delivery on this day here on the 19th. And on Monday night, I was mentioning to my private group, and you all know I mentioned this. I'm actually going to put a clip from Monday's video here, so that way the folks that were not in that group, they will have the the insights that was mentioned there. That way you can see what I'm showing here is not pointing to something that after the fact. I wanted you to, both communities, to appreciate what I'm teaching. Not to beat the chest, not to show off, not to sound smart, okay, but I want you to understand what I'm showing you here is rooted on sound logic. It's not chance, it's not gambling. So because this daily chart has retraced down into about half of the move from that low to that high, so we basically go back to equilibrium or roughly a short-term discount. So because of that, there's a likelihood that the daily bias is going to be bullish on this day here and this here. Now, we're going to look at this candle because midpoint of this candle, that right there is the mean threshold. Mean threshold is the half point, okay, or median of a order block. That's what this line here is representing. Okay, so when I drop down into the hourly and lower time frame, that right there is rooted on this up close candle. Why am I using that up close candle? Because from this high down into the 50% retracement of that low and high, where the market goes back to equilibrium or short-term discount, that means the bias has a likelihood. Now, folks, listen. You want to be taught about bias? I'm teaching it. Listen. So went down to equilibrium or short-term discount. The next day, we can expect it to go higher. So what do we do with that information? If it's likely to go higher the next day or the day after that, what happens if the next day is down or it doesn't move? Okay, you go into the next day expecting it to go higher. That's it. That's all you're doing. It's not hard, right? But you want perfect. You want your recipe for those chocolate chip cookies to come out like grandma's. And sometimes, guess what? It isn't going to be like that. You're going to have to take it the way it gives it to you. And sometimes your cookie ain't going to rise. This just so happens that what I outlined on Monday panned out. But that's what I'm referring to every single week. I'm outlining something that, because of the logic, that's that one good setup that you should be focusing on as my students. What am I going to show you here in this? This is your premium array. That means it's going to draw up into that. It could be this candle's low, because it's the order block, there's order block. Why should I be concerned about this candle? Because in this move here, right before this displacement on the downside, this was the last closed candle. So you have several targets here. You have the candle low, the open, the mean threshold, half order block, and you have the high. The high is the less likely. The easiest is one down here. So on this candle here, when we expect it to go higher, we can see it trade up into that candle's low. We can see it trade up into that candle's body. We can see it trade up into that candle's mean threshold. So it's not a matter of me picking levels and saying, look how smart I am. Look, it hit that level. But what about those other levels you didn't see? For those people that think like that, or if you ever hear that or see people talk like that, here's what you respond to internally. Don't even worry about that because they're not interested in learning. All they're trying to do is be a distraction to you. I promise you, if you put the work in, you will see the results. You're looking for the lowest hanging fruit. Which one's the easiest for you? Now, if you look at that in respect to this candle here. So if you're buying on this day, if you're buying down here below the opening, which I'm going to teach in detail in this video. If you're buying down below the opening, not that I use this particular opening price, but let's say you did. So you bought this specific day below that opening price on that candle right there, and you're buying below it. You could find profitability reaching just up into that candle's low. Draw that on time. You can use the body, draw that on time here. Hits it, well, today, not yesterday's stream, because that was yesterday's stream. And you have this here being hit there, and you have the mean threshold, the order block there. So there's several targets. Now, for you as a developing student, you want to pick the easiest one, which is this one here, and be content if it hits that. Now, blending that with the idea of purge and revert. Now, purge and revert, you can do a YouTube search on that. It's in my YouTube channel. It's a teaching that I'm going to allow you to go back and look at yourself, but it's kind of built on that same premise here. We went down, we took out short-term low, sell side liquidity. See that? Right below here. So we purged sell stops, and it's going to revert back to the high in the last 3 days. So day 1, 2, 3, that's this day here. So this candle's high, it can draw back into. So we have, yes, this order block low, but then we have this idea here where the move dropping down, that high is going to have what resting above it? Buy stops. Why would there be buy stops there? Because traders that are short, they're going to trail their stop loss right there. It's going to be more easily understood when we drop in the lower time frames, but just know that that's the framework I'm showing here. You are going to have to listen to this part of the video a few times. Don't be against that, okay? Don't feel like, I don't want to do that. Trust me. Put the time in to listen to this portion of the video because this is exactly what nobody is teaching you because they don't know it. But this is what goes on. And it's also the reason why I told my private group on Monday night what took place yesterday. All right, so we're dropping down to the hourly chart, and here is the E-mini S&P June contract. Market trade down into that short-term low, ran out sell stops here, or sell side liquidity, so it purged that liquidity. Then we had all this sloppiness starting the week, and then we dropped down and rallied up. Doesn't look too clean and clear here, does it? It's okay. It's about to change. We're going to drop down the lower time frame because we have a bias. I mentioned on Monday that I felt that this was going to go higher and clear up all this here. And that was the draw on liquidity. Now, here's that part of the video I said when we get into the discussion about live sessions, what am I going to be doing? Basically, what I'm going to show you a clip of when I get to the 15-minute time frame, I'm going to show you the clip from Monday night's private mentorship video where I discuss before it happened where the E-mini S&P was likely to go, why I felt it was likely to happen, and I'm going to amplify that here so that way both communities can appreciate what it is that I'm going to be doing with intraday price action. The guys over in Goldman Sachs, and you've been with me for a while, you know who I'm talking about, they like to say that intraday is just noise. And one of those guys actually said he tried very hard to make it work. And if anybody tells you that intraday trading is profitable and you can do it consistently, run away from them because they're con artists. Okay, it's kind of funny that I'm proving technical science because it exists. It repeats, but you have to know what you're looking for. Okay, and I'm going to show you that here. I mentioned the opening price on the midnight candle, and I mentioned the opening price at 8:30, and there's a lot of confusion as to what that means and what am I supposed to be doing with that information. I'm going to cover that in this video too. But I want you to look at this hourly chart and just see this movement here to here. See that? You don't have any reference points inside the hourly chart here. That's okay. I'm going to show it to you in amplification to what I was showing my group on Monday night before it happened. Do you see how level these two highs are here? See that? This is what I dubbed relative equal highs. That right there engineers buy stops. For anyone that chases this going lower, they're going to think that this is the area where resistance is. So their stop will be placed above that. Does it take rocket science to understand that? No. Every book tells every trader that reads the book that stops get above the old high. And this is resistance because it went here, stopped, went lower. It tried one more time here, and then went lower. So this is strong resistance. Now, granted, I'm not trying to make a case that hourly time frame is strong, okay? But there's a lot of people that trade in lower time frames, and they'll see that as what? Formidable resistance. So they'll feel that this is safe. The market should keep going lower. They broke this low, so that means it's going to keep going lower. And when the price starts going sideways like this, slightly up, it's going to look like what to them? It's a bear flag. So they're going to look at this high down to that low and project that same movement lower as a measured move, and this type of thing happens. Because they didn't use the context I'm providing you, both communities, understanding how the markets move from discount to premium, premium to discount. That's it. And then what PD arrays within the current market structure and what narrative. So what is narrative? What is that? Well, we have the market trading down into that short-term low, below old lows, about 50% of its daily range. that I mentioned on the daily time frame. So we've purged the sell stops. Where's it going to go? Higher. Why? It needs to go to buy side because it's now collected sell stops. So smart money is going to do what? Offset those buy orders that they used to pair out with the sell stops below these lows. They bought those sell stops. So now they're net long. How do they get out? They have to sell them to willing buyers. But at this point down here and over here, who's going to be buying from them at a higher price? The buy stops that are resting above here. So you have to think algorithmically, how do you pair your orders? If you don't have this mindset going in before you click the enter button of your trade, you are gambling. You have no idea what you're doing. You're trying to guess. You're in there seeing what would happen if I did this. And when it works, you're telling yourself, wow, if I did that with real money, I could quit my job in 3 months. Wrong. And when it's bad, you're thinking, oh, well, I wouldn't have took that trade anyway. I'm really cool and astute. I'm an apt pupil of price action. No, you're a gambler. You're downloading a demo account and you're not learning anything. You're conditioning yourself to believe that these sensations that you feel, when it's right, it's skill. And when it's not, well, that was just you just playing around. You weren't really doing anything serious about it. And that creates toxic thinking. And it builds a false sense of security. And in certain instances, some individuals literally go out and say, well, I'm going to put live money in there because, I got lucky a couple times and I could afford a couple $1,000 and I could do this and I could do that if I need that. And that's what everybody does. They fall victim to that. I don't want you doing that. You have to have a real reason why you're doing something, even in demo. Otherwise, you're teaching yourself to think, well, improperly about what it is that you're trying to do in these marketplaces. So the logic is we're looking for it to run above here. And now think about that in this area here. Here's the 19th on Tuesday. I told the group that it was likely to go to here. And I'll show you that clip. I'm dropping the 15-minute time frame. But now think about what does your daily candle look like if it's going to likely go up here and we're down here. It's going to create what? A little bit of a movement down, make the low of the day, then rally up to clean that low out. And we're not trying to predict the closing price on the daily candle. We're not trying to do that. We're trying to participate in a move in the morning session that gets us long, that allows us to run up into this area here, and that would be your target. You're not trying to get the move that goes all the way up to 45.90 if it was to do something like that. I'm not suggesting it is, but I'm saying that you have to pick these periods in the marketplace where it makes sense for you to anticipate and expect a certain move to begin and originate in, and where it ends or where it finds its terminus. So, point of origin, terminus. Buy orders on smart money, sell orders on smart money. Retail, buy orders. Retail, sell orders. That's the continuum that goes between smart money and retail. You have to change your thought process about what you're looking at in the charts, and that is narrative. Looking for the daily delivery on that candle, do a swing, buy below the opening price, expect displacement to the upside, run into liquidity, offset, sell to buyers, move to the sidelines, you're done. Now, what does that look like on a lower time frame? Here's the 15-minute time frame. Here is the relative equal highs, buy side liquidity resting there. Look at this price action here. What do you see? Pause the video. This is that moment where you want to study and look at it. Okay, I'm going to continue now. All right, so here we have this low. Why am I picking that low? Why not that low, Michael? Why didn't you pick this low, Michael? This here is a range that we worked in. I mentioned this is brutal when I was discussing it with my students on Monday in its commentary. But this movement here, this is the most recent swing low. It rallied up and it created a higher high right above these relative equal highs. So there, at point 1, point 2, that's your daily range. Okay, I'm using that because it's the most energetic, most recent low and high. This is where I think the market's going to go up to because I think all this movement down here basically has accumulated all the sell stops. So now smart money's heavily net long, and they are sitting on all these counterparty traders that either were knocked out of the marketplace and they absorbed all of their sell stops, or they're caught offside and retail's trying to go lower. It doesn't make a difference. I'm not suggesting that you should even waste any time trying to figure out what that is. I'm just saying that below old lows is sell stops, below old highs is buy stops. Just have it in mind, it's just that simple. Now, knowing that by itself is not enough. You need to know what is likely to occur. Here is the midnight candle in New York. Okay, how do you know that? Over here on TradingView, click this little area here. It'll pop up a list of time zones and such. Scroll to New York. Always put your TradingView chart on New York. I don't care where you live. You do that. Everything I'm teaching you will line up. Midnight opening price. The opening price is here. Draw that out in time. And that's your New York midnight opening price. This is the price I want to preferably be buying below. Now, there are instances where the opening price will be lower, and then the market is trading higher, but doesn't go back below the midnight opening price. This is why I said 8:30 opening price. 8:30 is when a news embargo lifts, and a lot of news comes in around 8:30 typically. And I use that opening price there. Now, in this instance, this is why I'm teaching it to both groups today, because this is kind of like just a dandy of a setup. It means it's really good. I like these types of setups. I'm going to show you here. When it delivers something like this, it's almost like it's presenting it to you on a silver platter. Like if you really, really want a good little setup that's going to just be a real nice cracker jacket, just delivers nicely, it's this one here, okay? If we're bullish, okay, and I'm assuming that you'll trust me when I show you the video clip from my private mentorship group, folks that are in my private mentorship group, if I'm sharing something that was edited, if I've changed that video in any way to make it seem or sound like something that really didn't take place on Monday at the 13-minute mark of that video, please say so in the comment section, okay? You're welcome to roast me, okay? I'm only telling you that because the comment section's open on my videos. You guys can say whatever you want to say. I don't care. Bottom line is I'm proving it, okay? I'm proving it. That way you can feel comfortable learning from me. There's no sales pitch here anymore. Just put down all your reservations and just grab a pen and pad and listen. And I promise you, what you're looking for, it'll come. The confusion you're getting about the opening prices at midnight and the opening prices at New York, 8:30 a.m. Last ditch for Power 3 is 8:30. What does that mean? If the opening price at midnight, if you're bullish, is lower than prices trading at around 8:30 or after 8:30, then it's likely it's not going to be a factor. Then you use 8:30. If there is a day like this one here, where you have the opening price at midnight here, we're already below it. And after 8:30, we're below it again, still below the midnight candle's opening price. We're really at a discount. Like we're really, really cheap on the day when we're bullish. Now think about what I've outlined so far. It seems like a long way here, but everything I've discussed is paramount and crucial for you to understand why this is occurring. Because these are the things that are going to repeat. Don't take my word for it. Start backtesting and logging your charts like this, and you will see these events repeating because it's algorithmic. It will not do it every single day, but every day it will be present in something. That's why I say with my motto, it's every week, every day, and it won't stop.
That does not mean every week, every day, and it won't stop every single individual market, because you have to be able to navigate. Some days it may not happen in the futures. It might be in forex or it might be in bonds. So you have to be flexible in that regard. Okay, but every single week there's this type of setup. Every single week there's a setup like this. Inside this range, it moved from here to here, and it started retracing down after midnight. Notice that? So all this here is a geoswing. Geoswing is the move that's opposite to what you expect the daily range to be. So if we're bullish and we think it's going up here, we like this movement going down. We love it. Now, you may not feel comfortable buying the London or overnight lows. That's fine. You don't need to. Wait for 8:30. If we drop below 8:30's opening price, and here's the kicker, we're below the opening price at midnight too, we are really, really oversold. Does it take indicators to see that? Nope. Did you require some kind of divergence? Nope. How about Fibonacci? Nope. Easy, isn't it? Visually see what's being shown here. Below the opening price, you want to be a buyer at midnight. By itself, it's always the basis of what I'm trying to do each day. Then, if we get an 8:30 candle that opens below the midnight candle, and then we have a movement below that, that move here also is like a micro Judah swing for the session of New York. This is a Judah swing on the daily range or the daily candle. So this is basically building below the daily candle. This is building below the New York session. Both are using the power of three concept, which is accumulation, manipulation, distribution. So what we're saying is this movement below the opening price at 8:30 and below the opening price at midnight, each move lower is the trap. It's the snare that catches traders thinking it's going down. We are looking for that move. We're looking for that drop down, not just any indiscriminate drop in price. We're looking for a very specific thing. Now I'm down into a 5-minute chart. Same things I have on a 50-minute time frame, I now have just showing and representing it on a 5-minute chart. I want you to take a look at price, study, think about what you see in price action here. Pause the video. If you're not ready, I'm about to begin. Right there. See that fair value gap right there? See these two unclosed candles? See that? That's your order block. That's bullish. Your fair value gap. At 8:30, we have a drop down. At 8:30, we're looking to the left and see where are our short-term swing lows, because we want to absorb sell stops, because smart money will pair that with their buys, and we're looking for an imbalance preferably, and we just happen to have it also with an order block. So there are a lot of things happening here. It comes down, hits it, and then rallies. 8:30, opening price, we find it come back down into it, find some support, and it springs aggressively above these short-term highs. By itself, that right there is enough. That's a beautiful run on S&P, and that would be enough. You don't need to have the objective up here. But if you're holding it for the daily range, you're going to wait for it to reach up in here, and it does so here. Now, in this area here, notice what happens. It rallies up and consolidates during lunch, and around the 2 o'clock hour going to 3 o'clock, we run back down into sell stops. Traders that have trailed their stop loss up because they don't want to lose any of their profits, and they pop it one more time up into the PM session or afternoon move into liquidity that was outlined relative equal highs on that 15-minute time frame. Here is the 1-minute chart. How can you apply what I've been teaching you on the YouTube model? Well, here it is. Here is the low forming. And now find the setup that would occur with the YouTube model. So as we're seeing the movement here, the bias is bullish. We're looking for a continuation on the upside. We have a target based on that 15-minute time frame relative equal highs. What does the model I'm teaching on YouTube, where does that exist here? Again, pause the video. Use this moment to really look for it yourself. If you just wait for me to show it to you, you waste the opportunity on learning. All right? Don't be upset if you don't get it. It's okay, but I'm going to show you now what you should be seeing. Okay, the market has a run above this short-term high, so we have a shift in market structure that's bullish. What's this? Fair value gap. It trades down into it, hammers it. 3 consecutive closed candles. That's what? Your order block. All consecutive. You're looking at 1-minute candles. That is the order block with fair value gap. Buy it there. And then comes back down, retests, sends it higher. And then one more time, New York midnight candle opening price. Opportunity again. Trades up into the New York midnight opening candle. Trades back into another gap. Trades into the midpoint of that. Rallies up. Consolidates. And then expands up into our objective that was outlined in that 15-minute time frame. The relative equal highs. Now let's dig a little bit deeper. Notice the price low here. It's around, what is that, 43.70 something? 76 or something like that. Well, just for the sake of clarity, we'll just say 43.77, okay? 43.77 is around here on this day. Now, what I've shown is the daily chart, but on an open, high, low, close bar, not a candlestick, because I want you to graphically see what's occurring here. Now, this opening price is not the midnight candle opening price, because you see it's about, what is it, 44.04 and a half or something like that. That would be just above where this opening price is. So my opening price is just a little bit above this opening price. So I'm not using the opening price on the daily chart on TradingView. You can. There's nothing really inherently wrong about that, but I don't personally do that. So that way, for clarity and continuity, I don't use the opening price on the daily candle. I physically go into my chart and use the opening price at midnight. Once that candle begins trading at midnight, that's your opening candle price for midnight. And same thing for 8:30. As soon as 8:30 starts, that opening price on the candle, that's my opening price at 8:30. So I have to wait till 8:30 to candle, or 8:30 exactly at the time, right when it happens, that's my opening price. I'm not referring to any opening or closing price on the candle. Okay, what I'm forecasting with my analysis concepts and teaching my students is I'm teaching them to anticipate these types of moves. So the relative equal highs on that 15-minute time frame is basically this candle's high. Go back and look at your charts and you'll see that's exactly what that is. So this short-term run below this short-term low is taking all the sell stops on that day, on the 18th. The 18th, that evening, I was telling my students that that is when I anticipate that the S&P should go higher and run for those relative equal highs on the 15-minute time frame, because we've already went down into a deep discount on the daily chart, and it's likely to come back up and grab that liquidity. Even if it's just going to keep going lower, that's still okay. It doesn't change anything. Even if it goes higher from here, and I'm wrong, it's reversing mix of longer-term rally higher. I don't care. We're looking for surgical strikes intraday for these markets as index futures. But there has to be some kind of logic. So if we look at what we've done over here and how this fits the daily candle, what I'm suggesting is that my opening price, because at midnight we're a little bit higher, and I don't need to catch that very, very short-term low that's lower than this one, okay? Because that low is right here, and actually a little bit lower than that to the left. I don't need that. This is the reference point at which my methods would see as an entry point. So that's real close That's like right in here. That's real close to the low of the day. I don't need to have the low of the day. You don't need to have the low of the day. But when you get to the New York session opening at equities 9:30 in the morning, New York time, this run in here, that sets it up. Another opportunity here. So we have optimal trade entry here. If you want to trade OT pattern, I teach on a YouTube channel. And it rallies up. And you're running all the way up the daily range until we get to that candle's high here, which is the relative equal highs on the 15-minute time frame. Go back into your charts and you'll see that. Okay, this is what backtesting does. It gives you the logic. So what's occurring here is what? It's purging sell stops and reverting back to the high in the last 3 days. Boom. Now, for some of you that need to hear me and what I said in the video clip in my private group, I'll play that for you now. 15-minute time frame, E-mini S&P futures June contract 2022. Again, just brutal back and forth, just consolidations. And there isn't really a whole lot in here that I like that I may want to reach for, except for just the old relative equal highs. To me, it looks too perfect. It looks too pristine, too classic support resistance idea. Okay, so, a lot of people want to sell short. They want to get short. They want to be bearish on this thing. And this is what's happening with all that. We're getting a run higher. It breaks lower. Then they send it one more time higher, clean up that, drop it once more lower. And now, to me, it looks like they're just going to send this thing vertical to clean that up. If it doesn't do that and it starts to trade lower, I'm not chasing it. I'm not trying to follow suit with that. I just want to give it more time to find out what it wants to do. Because to me, right now, we're so deep in discount on the daily chart, it can come up to this level here and really not upset anything if it's going to continue going lower. That's my point in saying that. All right, so hopefully I've covered a lot of stuff tonight. I talked about a lot of things that students have asked me to touch on in my private group, and I've obviously seen some of the comments referring to the opening price. What is the opening price? What is it? Why should I use it? And how to differentiate the importance between the opening at midnight New York and that of the 8:30 candle in New York session. So hopefully it's been a little more clear for you. But the main thing is you're looking for an opportunity to anticipate the expansion of that daily candle in one direction or the other, either higher or lower. And in that direction, higher or lower, where's it likely to go? And the easiest thing I teach is old highs and old lows and relative equal highs and relative equal lows. Those two ways of looking for pools of liquidity are the easiest, most visual representations of targeting there is. It's simple because it's based on sound logic that the algorithm will never be changed because of. Because old highs, right above that's always going to be buy side liquidity. Buy stops are going to rest above that. And below old lows, there's sell stops resting below that. It's always going to be that way, folks. It always will be that way. Don't send me comments in the videos. Please don't send me emails asking me that question. Do I think by me teaching, is it going to break it? Are they going to change their route? They're not changing anything. They can't change it because that's the way these markets book. That's the way it is, folks. It's the way it is. The sky's blue. Not all the time, but the sky is blue. The grass is green. Not all the time, but the grass is green. You follow what I'm saying? So these are rules we live by. Sometimes there's going to be these outliers, these things that creep in that cause your interpretation of price to be incorrect. And guess what that means? You did something wrong. Does that mean that you're a failed trader? No, it just means you made a mistake. That you're human. I'm human. I'm going to make mistakes. I'm going to read it wrong. I'm going to interpret it wrong. I'm going to react too late. I'm going to react too soon. I'm going to anticipate things that are not likely to occur, and then either I have to take a loss or I reverse. These are all things that you're going to have to be met with in time, and you're going to have to see whether or not this is for you. And some of you, in all honesty, this isn't going to be for you. Not my stuff alone, but trading in general, because it's risky. And don't ever think that something magical is going to happen. If you're not consistently profitable in a demo account, and you're not consistently finding setups, executing them, getting in and getting out with confidence, on the lowest of leverage. See, that's what I don't like about it. I know some of you are, I don't know how you guys link. I don't know how you guys link in the comments. People link me, but every time I try to link someone, either I'm putting a name in wrong, it never links it, so I never do that. But they'll make videos, and I see it as a mention. And YouTube, sometimes it's a day or two late, so it's not like I'm ignoring you, but for whatever reason, I get these notifications that are days late. And I see folks that are doing videos and they're recording themselves actually entering in the trades on the paper trading application on TradingView, which is great. But they're using leverage that everybody knows that they are not really in a position to afford. So I know it feels cool, it feels flashy, and it might feel like you're playing a video game. I don't want you to have that mindset. I want you to think about how you can make this as boring as possible. Because if you make it boring, you won't be a victim of your emotions. It'll be just like you go to work. I'm not saying you love going to your job, but doing those things that you go to work to do yields you what? That paycheck at the end of the week. That's your minimum expectation. Get to work and do what's expected of you. Anything above that, then obviously it's up to your manager to decide whether or not it's warranted to receive anything more than your standard pay. But you need to treat this just like that. It's a business. So when you're doing your executions, don't be influenced by trolls or hecklers in the comment section. Say, oh, well, you're doing micro lots, one micro lot. It's not about that size of leverage. It's about you finding the consistency of getting in, knowing what you're looking for in terms of managing the risk, in terms of the points or pips, not the money. Not the money. The money is a derivative of doing the right things. In the beginning, you need to focus on doing the right things. The logic needs to be there, not the reaction emotionally and psychologically to fake demo money. Don't do that. You're actually causing yourself barriers. It really is creating a barrier for you to find success if you do those things. It feels cool. It feels fun. Like, yeah, if that would have been a real trade, I could have made this much money. But you didn't. So let that be the reality. You didn't. So you're really tricking and conditioning yourself improperly, which is the opposite of what I teach my students with backtesting. Whereas I teach my students when they do their backtesting in their annotations, they write in there as if they saw the trade happening beforehand. And by doing that, it's like self-talk. You're speaking to your subconscious, and your subconscious is going to refer back to that as a false memory. Because it's a positive reinforcement, it teaches you because of pattern recognition and over again being exposed to the same elements, and you're reinforcing yourself with your own comments and your own cheerleading. You're fortifying your expectations going forward on this pattern yielding something in the past. Not that it's going to absolutely work in the future all the time, but we as price action traders, we look for signatures that repeat. Nothing is guaranteed that's going to repeat. That's why we have to stop loss. That way we know that there's risk in this market. Every market in trading has risk. But if you're going to hone an edge or a model, you need to have a framework. And you start by backtesting. That backtesting, in your annotations, you talk about how it feels good to see this move deliver as I was expecting from this fair value gap up to this buy side liquidity pool during the hours of this, and this is what my model suggests I should be looking for each day. Notice I didn't say I was stupid. I was playing video games and I was watching some YouTuber talking about some nonsense and I missed the trade setup. I should have known better. Never do that kind of stuff. Not in your backtesting, not in anything that you're recording in your journal. Everything has to be positive. You're sugarcoating everything in your backtesting. You're tricking your brain to see that as experience. So that way when you see it forming live, you're not going to be in fear and trepidation of, oh, it's going to be a painful experience. Again, when right now you don't have the experience yet, but because you keep logging it with backtesting, you're filling your brain up with a lot of pseudo memories. So you're doing the ideal utilization of a lie. This is called what it is. You're lying to yourself, and children love this. You're lying to yourself with positive reinforcement. Okay, so that way when you look at something forming in real time, it will be remembered, and you won't have any negative triggering because of toxic annotations or toxic thinking. You'll have memories of, oh yeah, I remember seeing that in your subconscious. You may not see it or understand it or feel it when you're doing it, but your subconscious reverts back to those experiences that you've logged with positive reinforcement. Don't take a demo account and do that same thing with, I'm going to over leverage my demo account or paper trading account and do a size of leveraging that there's no way I would be able to, number one, put the trade on because I would be too scared because I'm a new trader and I'm going to be afraid of any fluctuation. If I put on $1 million worth of leverage, I can't really sit through the spread opening up on me when I have to put the trade on initially, let alone weather the ups and downs and initially, as the trade pans out. You're teaching yourself to anticipate a hopeful outcome with ridiculous leverage. And you're teaching yourself that negative drawdown that you're experiencing is not something to be worried about because you're only looking for the dopamine hit if you did it right. And that video game high score means absolutely nothing in your growth. You've created a speed bump and sometimes a barrier to being consistently profitable. Think. When you do those things, what you're saying is, I'm putting blinders on. I don't really see the real risk here because it's paper money. And I want to show on my video a really high profitability in the end result because you want clout. Every single time, I see one of my students, whether from the YouTube community or some of my mentorship students that are in private group that have YouTube channels, they'll make a video and they'll use really high leverage, but they may have executed extremely well. Manage the whole thing from beginning to end. My comment consistently is, next time, even though I've commented and said, well done on the other stuff, I will always tell them, next time, use realistic leverage. That's my only criticism. Not because of me trying to kick their legs out from underneath them. I'm not trying to steal their steam or their drive or motivation. I'm being the best influence I can because I don't want them filling their head up with things that are toxic because that's what that is. It's all about clout. You don't want clout. You want consistently profitable. Trust me, being consistently profitable feels a whole lot better than clout on the internet. I don't need everybody to love me. Look at me. I've been here for a long time and there's a lot of people that hate me for no justified reason. But the point is, none of that stuff causes me to lose any sleep. So don't invite those environments where other people can influence your performance, your expectations on yourself, your model, your trading. None of these jokers on the internet should have any influence on you. None. They don't have it on me. Why? Because I have deep-rooted sound logic in the things I'm looking for. You all are experiencing that. You're seeing it firsthand. You're seeing it. And it's encouraging. So don't make the mistakes of adding these little things, these flavor enhancers to your experience, okay, and calling them something that they're not, because they're not going to make you better. They're going to actually hurt you by over leveraging just because you want to see big numbers show up on your trade. Everybody watching knows that you put a demo trade on. Everybody knows that you put a paper trade on. They know. So don't, parade around with it like it's a big deal. It's not. So the way you make it more respectful to your viewers and also remove the element of clout chasing. Use the smallest leverage. Let the people that want to heckle, let them heckle. You worry about being consistent. If you want to showcase your skill set, do the executions and use the lowest leverage possible. And let that be the example that you're showcasing. So I think I've gone through a whole laundry list of things I'm supposed to cover tonight in this. And I know it's a very, very long video. I know it's probably long-winded for some of you to like to see me get right to the point, but this whole thing was at the point. And it really is a clinic on how to operate and engage the marketplace using what I'm teaching, even with what I'm teaching in the YouTube model. And I'm just so thankful that the community has really received it well. The comment section is just a love fest, and I absolutely love it. Please don't call me the goat. I won't ever heart your comment if you do that. It's not that I'm ignoring you. I just never do that. Don't call me a king. I don't like those things either. Appreciation or the things that you've observed in your own development. I love reading those. And I just thank you for all of your support of the channel. I think it's wonderful. I think the community is growing, and I think it's just a healthy experience for all of us. And I'm finding a great deal of pleasure doing it, which is what I was hoping I'd get from it. So 228,000 followers. That's pretty crazy. Like, it's really growing fast. At this stage, I'll probably have a $250,000 by the end of the year, which is really nuts. But thank you very much for your time. Hopefully you got something from this one. And until I talk to you on, hopefully tomorrow, I guess it will be on it. So I'll have another video up on YouTube tomorrow night around 10 o'clock. Until I talk to you then, be safe. All right, folks, welcome back. I guess it's like yesterday, last time we spoke. All right, so here we have one of those instances where, as luck would have it, the hands of fate, the planets aligned, all those factors came in on something I gave you in an analysis last night. Now, before you start snickering and rolling your eyes and sending your husband up to slap me on stage, just understand that this is just one little piece of price action and the delivery that the algorithm will likely, not every single instance, but it will likely repeat. Okay, it's the logic I've shared on this YouTube channel, and I've been asked, obviously, if you read the comments in the videos, can I show an example of this working in London session for Forex? No problem. To do that, I set the stage with the analysis last night. There are folks out there that will say, I don't know how to pick the tops and the bottoms or the highs and the lows of the day. They don't know what I'm teaching, so it's easy for them to say those types of things. And a new student may stumble upon their comment, may stumble upon their YouTube channel, and whatever their medium is, they follow that logic without investigating it or looking into whether or not these things that I claim are true. So without a safety net last night. I outlined it for you. I explained what it should do, why it should take place, and therefore we watch. And do I see in my chart, like you should see in yours, what I outlined? Not exactly to the level I was outlining, but the general premise was there. What do I mean by that? Well, we were in this area here, and I mentioned that I felt that it was going to go below the 100 level. And if I were making the market, in other words, if I was the market maker, providing the parameters at which the dollar index will go down to set up a buying opportunity, I would take it down to the 99.92 level. Okay, and you can check me on that with the video I uploaded, and I can't edit a video on YouTube. Once it's there, it's there. Okay, so I know some of you are actually downloading them. That's fine. But go to episode 19, which is the one I just did last night, and listen to the 20-minute mark around 10-second in that vicinity, and let it play for a minute or so. And you'll hear me outline the very thing that you're seeing in your chart right now. So the question is going to be, how did I know to call that level, and why did I know that it was likely to set up a London setup? Well, I'm going to teach that to you tonight. So understand this is not the model for my daughter. This is not in addition to the model. I'm just simply answering questions because I got a lot of them, and I'm not trying to push this inside of the model for this YouTube mentorship, because the next step is going to be, can you go into London and do live sessions so we can copy what you're doing? I'm not going to do that. Okay. Now some of you are going to be upset, say, oh, well, see, you're not proving anything. Well, if you're not seeing this as proof, move along. Okay. Just move along. I'm only going to do what I'm going to do. Okay. And I'm having fun showing what I'm showing, and it's really enough. Only those individuals that want to be spoon-fed setups and trades and piggyback my ideas, they're the only ones that really push and twist my arm, and they're going to be frustrated. So I'm just letting you know that's not going to happen. So don't ask. I don't care how many times you present it nicely in a comment or request. It's simply not going to happen. It's important for you to go in and find these setups on your own using what I'm teaching. So I mentioned that we would drop below that 100 level. Why did I pick the 99.92 level? Okay, well, if you look at the price action right over here, okay, we had this run up at the beginning of that candle right there. Just draw that out in time. I gave you about 99.95, 99.92 level. Okay, a small little range of about 3 pips. That's what I was eyeballing last night. Now, I was talking to you, obviously, before midnight. Now, there's things that I teach and have in my repertoire that helps me fine-tune the low of the day, and I'm not going to teach that here, because I have a community, obviously, I'm obligated to. I'm not obligated here, okay? So I don't want you thinking you can guilt me into doing more than I'm already willing to do, but just know that there's things that I can basically use in my repertoire at midnight that will help me fine-tune the actual low within about 2 to 3 pips. Sometimes right on the very low, but it's not needed, okay? The idea that I just gave on the fly last night when I was doing the commentary was really simply just reading on the idea of this extension and ending it right on that candle's high, and just eyeballing it. So that's what I was looking at. I expected it to drop down. I'm not convinced that we're going to see this top yet. So I felt that it dropped down here. And also, being a setup going into London, that's what I would expect. And I'm going to teach you how to use that information if that's what you want to investigate and study on your own. But notice that we ran up above these relative equal highs, and that's what we ran for the intraday price action target. So the high of the day that was set initially around the midnight time frame, it dropped down, creating the entire run lower, creating the London low, real close to where I was outlining. Not exactly, obviously, but it's good enough for government work. And the market starts to rally and it takes out the initial high of the day. But more specifically, it aims for these really clean levels. You have this high here, here, and here. Remember I was teaching? Just like this level here, the market does not like to leave that. That is not efficient. Now, it's efficient for technical analysis, Retail 101, where they'll see that as resistance. It looks perfect. That's what they want, because the books teach that. The books are meant to trip you up. It's flawed logic, folks. I mean, I hate to say this type of thing to certain individuals because they take aim at me like I'm trying to belittle everyone else. It's not that I'm trying to belittle anyone else. I'm trying to shake you by the lapels and simply say, look, listen to what I'm saying. Don't believe what I'm saying. Investigate the things I'm stating in the video. So that way, you can come to your own conclusion. Either I'm making things up, or there's really logic behind it. And you can dismiss 99.9% of the things out there that everyone looks and relies on to have in their charts as far as analysis concepts or indicators. You don't need all that stuff. So if I'm suggesting, as I mentioned last night in the video, that we would drop down here and then start to go higher, that sets the stage for what? If this is going to be a point at which it reacts and goes higher, as I was outlining around this time period in the video, that means the opposite should be seen for Euro. But before we get into that, let's fine tune this a little bit more in a 15-minute time frame. You can see we drop down creating the low of the day in London Open. That's our kill zone that I teach here on the YouTube channel. It's 2 o'clock in the morning to 5 o'clock in the morning, New York local time. So if you are using the time window thing over here, set it to local New York time, 2 o'clock to 5 o'clock in the morning, that's the kill zone for London Open. Market comes down, creates the low of the day, runs back up, back into an order block here. I'll let you look at the lower time frames, and you'll see that is in fact an order block. And optimal trade entry, and the market starts to create its run up into the relative equal highs, sweeping that as a daily objective. Now, if this is the low of the day, and if it's what I've outlined in advance, and you see that last night beforehand, this is what I expected to see price drop down in and then start to go higher. At the same time, Euro runs all the way back up to the previous week's high. How is this likely to be a false breakout? We have to use intermarket relationships like I'm showing with dollar index. So if you're trading Forex, it's important to relate your analysis in the trading market. Okay, for instance, if you're looking at Euro, that's your trading market. You have to have a barometer, something to measure its movement with, and that's intermarket relationships. So having that with the dollar coming down to the level I outlined last night, it would be a bullish area. It'd be a sensitive price point to see an advance higher. Because its relationship with Euro, it's inverted. So if dollar is going down to that level being 99.92, then it's not a surprise to see Euro rally higher as it's doing that. But what is the Euro reaching for? This high, and then went so far as to go up above the previous week's high. So they really reached up in there, took out the previous week's high, and at that same instance, right there, that's when dollar hit the objective I told you last night. That would be a buying opportunity for dollar. If it's a buying opportunity for dollar, then it's a shorting opportunity at that very moment. Look at your own charts and study the moment it hits this level here, it's the same moment that the dollar index is hitting that area I was outlining last night for a buying opportunity for dollar. So this is a false breakout because my analysis was done and shared with you openly that would be a buying opportunity for dollar. Setting the stage for what? As I outlined, I'm bearish foreign currency. Could I have bought that? Sure. Because I'm expecting the dollar index to drop down to that 99.92. Did I? No. I went to sleep. I was tired. So I'm not concerned about that. I didn't take the short either. I don't care. I don't want to be in every single move, and I'm not trying to trade Forex right now. But to prove to you folks that are sitting out there asking to see if it can be done in London, does the concepts work? Can I call a move? Can I give an idea? Can I do these things before it happens? Yes. But simply because I can doesn't obligate me to. Okay? I'm not here trying to perform magic tricks for you. Okay? I'm not trying to do that. I'm trying to teach you to trust your own analysis and lean on your own experience, even in the early stages when there isn't that much of it. It's okay. You learn to grow gradually. All right, so the 15-minute time frame, you can see that the euro went up into its kill zone here, 2 o'clock in the morning, 5 o'clock in the morning, New York local time. So it creates the high of the day. So in this price run, we're going to start stripping it down. I'm going to make it very easy and not make this video very long, but I'm going to drop right to a very small time frame chart. 2 minute has the very clean fair value gap. So after it ran above that old weekly high, the market trades lower and takes out that short-term low. Now, some of you might see this short-term low and say, well, why didn't you use that low instead of this one here? Well, the reason why is the fair value gap forms right here on this candle. Once that candle closes, the very next candle, it opens essentially right at that low. So it hasn't really moved away and hasn't really shown me what? Displacement. Something energetic where it moves away from that fair value gap. That's the important factor. So we have the fair value gap here, and then it moves lower than that short-term low. Now we have a shift in market structure. The market could have came back up into this run here and offered an entry, but it didn't. Just that. It went a little bit lower. That's fine. And then rise up to that level here. This is the entry point. Now, think about where your stop loss would be and think about where your entry would be based on what I taught you using New York session. This is an opportunity to pause the video and think about it across your annotations. You're smirking, aren't you? I'm not pausing. So you just might as well get on with your ICT. Okay. So here we have a zoomed in 2 minute chart. And here is the fair value gap level that you would be putting your limit order in. So it's still essentially right there. Remember, it's not going to be placed in the marketplace for a shorting opportunity or entry on limit anytime in here because it has to move away from the fair value gap. So it does it on this candle here. So we have that run through the short-term low. We have displacement. There's energetic move lower away from the fair value gap. It doesn't get to it here. It goes a little bit deeper. We wait. We don't chase it. We don't go in here thinking, oh, well, I missed a move. We still have time. See all this over here? The kill zone for London Open is still open. So we allow for that retracement higher. Your fill here, maybe 1 pip at, maybe a half a pip, or maybe a full pip above this candle's high. That would be your entry, but we're just going to use the actual candle high. That would be your limit order entry, hypothetically, 1.0924 4 pipettes. That's your entry. Your stop loss will be above the high here. That comes in at 1.0936 and a half. And the heat, or the drawdown that you absorb, hypothetically, if you would use that entry point, is 1.0931. So basically, not even 5 pips. Okay, so, well, about 5 pips, around about 5 pips of drawdown. So essentially 25, we'll call it the 30. So call 5 pips there, it's done. So 5 pips of drawdown, and never came to your stop. With this gearing, okay, if you use sound money management, how much can you risk if you're risking $1,000 per trade? Okay, you're thinking about money-wise, don't do that. You think about it in terms of fixed percentage risk on equity. So that means you're simply going to look at how much money you have in the account, take that times that by 1%. Okay, 1% is the maximum. Preferably, you should be doing a half of 1% or maybe a quarter of 1%. You're learning. You're trying to do a lot in the beginning. You're trying to just simply trust the idea of seeing these moves. None of you should be going into demo. None of you would have done this, obviously, because we're talking about in hindsight. But I'm showing you the relationships of how when the market went to this level here and created 5 stops on the previous high, 1 euro, that's the very moment that the dollar index went down to the level I outlined. It would be bullish. So the teeter-totter effect, or the inverse relationships, that if the dollar's going to go higher, that means that it's going to have weight introduced to euro and it should start to go lower. So your entry here and your drawdown and your stop, all those being what they are here, we go out a little bit further, and I'm just using a 5-minute chart so I can put everything in the fractal. In other words, the fractals just move up and then down. That way you can see it all and have the candles still be clean and have everything on one chart. So that's the only reason why I'm showing the 5-minute chart. It's not that I'm doing anything special with it. Okay, it's just to show you the overall dynamic of this price run up, the rejection, the optimal trade entry that would be used with the fair value gap used on the 2-minute time frame, all the levels and things here being as they were on the 2-minute chart. And if you did a Fibonacci run from the low here, lie this one because it was most energetic starting this price run here, that would be your apparent price leg. 50% is around in here, so that would be a nice objective initially. That would be your first target. If you're going to hold for the full day, it could go down to this area here, and lo and behold, we have that imbalance. You trade right into that rather handsomely. So there's your example using it. I gave you the framework beforehand. I told you what to expect in the dollar index, and everybody should know that the euro is going to be the opposite direction of whatever the dollar's going to do. So hopefully this has been insightful. So you got something out of it. So I'll talk to you next time, next week, next Tuesday actually. Lord willing. Enjoy your weekend and be safe. All right, folks, welcome back. This is our 21st episode of the 2022 free ICT YouTube mentorship. Tongue twister there. So we're looking at the hourly chart on the dollar index. Why are we here? Why are we looking at this? Well, I'm looking at this because I want to show you the relationships between a risk-on and risk-off market. If you've been following along in the comment section, and if you haven't paid attention or even noticed, all my videos in this mentorship, the comment section is open. Okay, so you're welcome to make your appreciation known. You're welcome to, prompt me with specific questions that you want to see me kind of like touch on without making too much of a long-winded request for it. I can kind of get a feel for what you're looking for, and I'll work those ideas into the lesson so we can hopefully get everybody's understanding on the same page. I may not respond to your post. I may not, directly answer you. Sometimes if it's short and easy, I'll do that. But if it's a question I see a lot of across the other videos as well, I use the videos to kind of like answer it. So it's important you take notes because usually you'll find that the questions you have are answered in the progression through this mentorship if you're coming here later than 2022. All right, so one of the questions I got, and I get this a lot for people that have not been trained by me, the idea of using the dollar index, is it useful like when I look at the Forex market, like if the dollar's going higher, obviously that's going to put pressure on the foreign currencies, be less likely for them to have sustained rallies. They're more likely to have sustained declines. So dollar up, foreign currency down. Dollar down, foreign currency up. The reason why that's occurring is it's a risk-on, risk-off scenario. Dollar, if it is going up as we have here, this is a risk-off scenario. Okay, risk-off scenario implies that generally every other market or asset class will start to decline. And this is treated as like a flight to quality, okay, or a safe haven. So money pours into the dollar, and it pours out of risk assets. That would be like foreign currency. That's why I've been telling you to look at the euro dollar to go lower and make a new low on this daily chart. And today it did. I know it's random. And then also, this applies as well to the stock market and index market. So obviously, I'm kind of like pushing the index futures in this mentorship on YouTube, but it's applicable. Obviously, everything I'm teaching here is universal, so it works in everything. Now, I'm not co-signing crypto. As a reminder, I do not trade cryptocurrency. I have absolutely zero experience trading cryptocurrency outside of a demo account or a paper trading account. I've never done anything with it. I've never opened up a crypto account. I have no interest in ever going into the asset class, and there it is. Okay, I see a lot of you asking that in the comment section, so I'm going to try to throw this out there every now and then as a reminder, because I don't do anything with an asset class. I have a lot of students that trade them, and they swear by my concepts work in there, but I personally don't do it. Okay, so there's that. I'm a Forex and futures trader, so that way you guys can know what my specialty is. And I want to show you this chart here and remind you of what I mentioned in the previous week in our meetings together in the episodes. I said that we would likely see the dollar index drop down. If I was making the market for the dollar, I would see it go down to around 99.92. And you go back and listen to the videos, and obviously you'll see it. It's there and hear it. Then I said I would run the relative equal highs and start to run it higher. I gave you the objectives of relative equal highs and mentioned like 102, 103, and even my private mentorship group knows there's objectives as well. And we have it here. Okay, so I'll leave it up to you whether or not you find this inspiring or not, knowing that this was likely to occur for a London setup and then rally higher. I want you to look at the relationship between this price move here and go back in the commentary where I was referring to that daily bearish order block on the index future. Okay, so I was talking about the low of the daily order block, the open of the order block, and the mean threshold halfway, and then the high of the order block being the less likely level to trade to. And I'll talk about that when we get into the E-mini S&P portion of this episode. But for now, let's take a look at what the relationship looks like with the dollar versus the E-mini S&P. So this is the June contract for 2022 of the E-mini S&P futures market. And you can see as the dollar creates this important low that I called publicly, you guys know it, I've said it, I've explained it to you in detail. As this dollar was going higher, what was going on in the E-mini S&P? See that inverted relationship there? That's why if you go back and listen to the recording, when I was talking about that bearish order block on the E-mini S&P, I said that we're going into May, and it's usually a seasonal decline. And I'm going to be looking for signatures to warrant downward pressure in this particular asset class and reaching for those relative equal lows on the daily chart. Hello, look at your chart, folks. This is what it's like to be mentored. This is what it's like to know what's likely to occur with tools that make sense. There's nothing ambiguous here. There's nothing, splattered across the chart. It's just simple, sound logic. Okay? I'm hopefully inspiring you to simplify, which many on the outside looking at what I do will make snide remarks like, oh, he overcomplicates things. And I'm not complicating anything. These are very simple ideas, and it helps you build the idea of bias. It gives you intermarket relationships and intermarket analysis to give you the trust. Okay? Why did I feel confident to publicly say that 99.92 level? Well, I explained that. Why did I think it was going to rally from there? Because I'm bullish on dollar. Why did I hint that we're going to be going lower into the E-mini S&P relative equal lows and as we enter into May? That's a seasonal tendency. So all those factors came together. In my experience of almost 30 years, was used to hint at something for you to study. And if I'm right or if I'm wrong, you get to be a judge. Okay, you get to see and weigh me in the balances. I've laid it out there in your hands. You see right now in this chart what I was forecasting, the reasons why I was doing it, why I said what I said, and why it looks like it does in your chart today. All right, so here's that daily chart, and here's that bearish order block I was referring to. And the high I said is the level we don't look for it to be traded to, and you can see we didn't even get to it there. Okay, so we ran up into the order block, and then we had the weakness that was expected as we go into that May month, and we're reaching into these relative equal lows. That's the next draw on liquidity, but for now, again, just keep your study inside this order block. That's taught in this YouTube channel, okay? So while it's not a main factor in the model I'm teaching in the mentorship for YouTube here, I leaned on that as a basis for my analysis. Why I felt this was likely to go lower, that's the order block. That's the one that makes the likelihood of the market turning in this area and then going lower and attacking the sell side below here. Below the relative equal lows here is next, and then this low here. So ultimately, we're looking for a run below here for the sell side. Now, it might want to go down below here and give a little bit of retracement if it leaves this portion open. That might want to rally from going over here up there. I don't think it would do that personally, but it could happen. But it's likely to draw into that old low here. Now, how we trade once we get there, that'll be interesting because I don't know if it's going to accelerate violently to the downside or if we're going to have a sharp retracement higher. I don't know that. Okay, I don't care to know that. Right now, I'm just looking for and submitting to the idea that we're going to keep drawing down on the daily chart. Each daily candle should be expanding lower and reaching into this area. Okay, that's what I'm expecting. That's my ideal scenario. Now, if you look at the daily range here today, we had a little bit of movement above the previous day. So we rallied above Monday's high and then failed and accelerated to the downside. Fell short of just running below these relative equal lows, but I still believe that's where we're likely to go. Had a little bit of consolidation in here, dropped. Then we had a nice rally in here. Now, admittedly, listen closely, folks, because this is one of those times where I didn't get it right, and I have no problem telling you. I was expecting this to rally just a little bit higher and maybe flirt with that 43.20 level. I thought that we could get one more spike up into that, and then I was expecting to roll over and go lower. That did not happen. Okay, so let's go into the lower time frame, 15-minute time frame. Here's the midnight hour, New York time, and the opening price there. Notice we only had 1, 2 little moves above that, and that's a really anemic movement for what I was expecting a little bit more pronounced rally higher. I wanted to see a little bit of juice swing, about 20 handles, 15 handles to that effect, like that, and then break down and create something like this. Okay, but we didn't get it. So some of you may be asking, and I believe it was Michelle in the comment section, mentioned that it didn't appear that Power 3 was in effect today. It actually was, but sometimes it's really, really small little movements like this, and it may not be useful to you. But what happens is when you enter the London session, which we do here, on 3 o'clock in the morning, it breaks down relative to New York local time. Okay, so 3 a.m. New York local time. There's a lot of folks in the comment section that are referring to and confused about daylight savings time and such. All of that is resolved if you simply just listen to the instruction I gave every single time I mentioned the time aspect. If you use this little area down here in TradingView and toggle it to New York, And all you do is by clicking it, a window will pop up, scroll to where it says New York, highlight that one, click it, and then you're set. You don't have to worry about it. Don't worry about daylight savings time. Don't worry about anything. As long as you are aware of what local time is in New York, set a clock on your computer that always tracks the local time in New York, 24/7, 365 days a year. If you do that, you'll never have any confusion about what you should be doing relative to time. Okay. So if you have a small little movement like this, it can throw you off if you're expecting, like I was. I wanted to see a little higher rally. So in the morning, I was looking for maybe a little poke above here. Didn't happen. We broke down, retraced back in, bearish order block, and the imbalance, and spent a little bit of time here, and then rolled over right before the 9:30 opening. Okay, and I'm gonna talk a little bit about the 8:30 and the 9:30, what times are useful, what are beneficial to your analysis, and what you should be concerned about. Okay, because there's a lot of questions about that. But ultimately, we moved into the lunch hour, had a little bit of retracement here, broke down once more, and then aggressive selling, really aggressive selling into the PM session, into the close of the day. If you look at the opening price at midnight local time, New York midnight local time, that's what this here is. That's that opening price. This price is useful for trading the London session. That's 2 o'clock and 5 o'clock in the morning, New York local time. And it helps me frame the power 3 for the daily range. If I'm bearish, I'm looking for something to rally above that opening price in London. That's my ideal scenario. I'm looking for that personally. As you can see, we really didn't get much of that today. It was extremely heavy and just wilted and went lower. Sometimes that's going to happen, folks. And in this instance, I missed a setup. I don't get in what I'm thinking I'm expecting to see. So I'm human. You're human. You're going to look at something in the chart and you're going to have something that is your favorite model, whatever pattern is you're looking for. And it may not even be my stuff. Say you're just here casually watching. You're probably nodding your head saying, yeah, I've had lots of instances where I was looking for my particular setup and it didn't materialize and it went the other way without me. You're going to miss moves. You're going to misinterpret. You're going to read it wrong. And that's going to happen. That's why you have to use a stop loss. That's why you have to be controlled about how many times you go into the marketplace. And you also have to have some measure of flexibility. And that comes with experience. You're not going to always be able to see that this isn't going to go up for you initially. It's just going to just wilt and go the other direction. So when we get into the 8:30 hour, now I have the lines really light here because I want to be able to show where the highs and the lows were on the respective candles. So this is the 8:30 and this is the 12 a.m. midnight candle in New York. So this is New York and this is midnight New York. So there's a distinction here. The beginning of the day, this is where I look for the daily range power 3 setup and or the ideal scenario. If I'm bearish, I want to see something rally above that opening price. If I'm bullish, I want to see it decline below that opening price. Okay, that's pretty much the basis for the opening price at midnight. It may not be a factor for you, like it is here. It's not much of a use, for anything except for, well, here it opened and it just basically went lower from there. At 8:30, the same thing. I look for these types of scenarios. So now I'm looking for weaker prices. I'm looking for it to trade lower. And does it rally above the 8:30 opening price? It never does. It's too heavy. It just wilts. Okay, it keeps going lower. Now, the opening price at 8:30, I use that for, again, power 3 for the New York session. The same thought process I'm using for the opening price at midnight in New York time. That opening price, if I'm bearish, I want to see a move above that. That's what I dub a Judas swing, a false rally, or a suspect rally. I usually like to fade those types of moves. As it goes up, I sell right into it. It's scary for someone who doesn't understand what you're looking at. But if you know what you're looking for, and it takes a lot of experience and learning and back testing and seeing things, you'll be able to do those types of things over time. But that same element of trying to look for a short above the opening price in New York when I'm bearish, I would expect the same thing to happen for the New York session, a rally above that opening price at 8:30, and then decline. So I'm looking for something to rally above that and fade it, but it isn't doing it today. So now look what's occurring here. This is really important that you understand this part of it. You know that I've been bearish. I've made it public knowledge here. Did we rally above the opening price at midnight? No. Did we rally above the opening price at 8:30? No. And we're bearish. What does that indicate to you? Obviously, with the benefit of hindsight, it's extremely bearish. It can't even rally to a short-term premium above the opening price at key levels and time. So we have an extremely heavy bearish market. So it's not going to give us these stunning little short-term rallies that we can fade. It's just going to stay heavy, and either you get in where you can find small little pockets of imbalance, or you miss the move entirely. Now, as it happens today, my wife went on a trip. I had to take her to the airport. I was only able to capture $2,000 worth of movement in the S&P E-mini. That's the only thing I could capture. When I got back, I didn't participate in the afternoon, and looking at it now, I missed a really, really huge opportunity. There was no trading whatsoever in the afternoon. My money was made short on E-mini S&P in the morning session, and that's all I had for today. If I would have just held on to what I had in the morning, I could have done around $12,000 today alone. But I didn't hold on to it. I had other things to take care of, and that's the reality of things. Real life creeps in. It's going to happen. But for those of you that are trying to learn these concepts, these types of movements are going to be very frustrating in the early stages of your development because you're going to feel like they're changing something. They're aware of this. This stuff goes on a lot. It happens in the futures markets, like commodities like corn, soybeans, gold, oil, stocks. Sometimes the markets are just simply too heavy, and they're not going to rally for you, okay, to short into it. It doesn't mean that they've changed anything. It doesn't mean that the concepts don't work. It just means that this is a market that is extremely bearish. And when it's extremely bearish, you have to trade it differently. And I'll show you what I mean by that here. And I'm not trying to inspire much outside of the mentorship, but I know some of you have asked this in the comment section. Plus, it helps my own personal group to understand this as well. So it'll be a little bit of a refresher for them. All right, so here's the London Open setup. This was the move that set up the only real sound entry, in my opinion, that took place today. Here, this displacement, fair value gap, rallies up, bearish order block, fair value gap, runs into it, and then you hold it. Because of the market structure, shift below the short-term low, the imbalance, we're going back up in. This imbalance here, remember when I talked about this? This one here can be traded to on a spike. It can get up in there, but your entry is on the lower fair value gap. You see the logic working here? You are going to use a stop that's going to allow for the market trading up into this one. So you may not like that much risk. You may not be able to take this trade. That's all part of this game. But you can trade a micro, or maybe you could. I shouldn't say that you can. I don't know what all of your risk parameters are, what you can work with in terms of margin. But while you're learning in paper trading, obviously, you can use anything because it's all hypothetical money, and you're learning a skill set. But the rules are still sticking to what I gave you in terms of the logic. If you have two fair value gaps, you're using this as the entry, and you're using this as the risk. Don't always assume that you can get up here and get the best entry because it never went there. See that? So it's things like this. This is what I refer to as a signature in price action. These are algorithmic things that repeat, but you have to have the discernment and experience to know when it's likely to occur, when it isn't likely to occur. So anyway, let's talk a little bit about the 8:30 time period and 9:30. All right, so here's 8:30. Got the imbalance here. After 8:30, normally with the model, I'm teaching you to look for something to the left prior to 8:30, some kind of short-term high. You want to see it rally up. And using the opening price at 8:30, which is here, we want to see it rally above that, run some stops, then break down and create this type of scenario where it has displacement and a imbalance. It rallies back up into the imbalance and sells off. The model doesn't exist in today's price action on the 5-minute chart. It doesn't give it to you there. Okay, so I'm going to give you coaching, if you will, to kind of like show you what was in price and some of the things I was looking at to help get in sync with the move, but I didn't ride the whole thing out. Okay, and believe me, I'm looking at this today, wishing I just would have had at least one of the 2 contracts I had on still and just let it run, and I could have done about $8 grand or so. But I didn't do it. Okay, I was leaving. I was taking my wife to the airport, and it's just better if you're not going to be in front of the charts. And anything can happen. You have to get delayed out there. The phone doesn't connect with the the broker. It's just better just to be away. If you're not going to be paying attention to the marketplace, just simply completely close the entire position. Also, I'll throw this in here too. Or shortly before I started doing the recording here, I saw a question: do I ever hold overnight in these current conditions? I stopped holding overnight like 24 hours years ago. We had a lot of things going on in the world that changed my trust. Just like I used to hold things over the weekend and expect continuation going into the opening on Sunday and Monday, I no longer hold over the weekend. So I am 100% in a session or a day and out before the close. Like I'm not holding 24 hours. I'm not holding 12 hours. I'm not doing those types of positions. Typically, my trade is anywhere between 90 minutes to 2 hours maximum. That's about the length of time that I'm holding. And I'm looking to take mine and get out and then reassess things because there's just too much risk right now in the marketplace, all asset classes, and things are now starting to get a little wild, and it could get a little bit more wilder. Okay, but the 5-minute chart has the imbalance in here. We saw that run, and the model, I want to see it run above the opening price at 8:30. The opening price at 8:30 is the New York sessions opening price. Now, don't get confused with the New York midnight candles opening price because the New York Association in the name, New York session is the 8:30 to 11 time period, New York local time. So I'm looking for this framework to offer Power 3, which is a fractal element of accumulation, manipulation, and distribution. That's what Power 3, the 3 things that is empowering you is understanding those 3 elements. Accumulation, what's accumulating? Short positions, okay? Why? Because it's bearish. So smart money would accumulate short positions, then anticipate manipulation above the opening price. They would assume more short positions there. Then it starts to go the other direction, and they distribute their short positions at some important low that we're able to forecast. And obviously, it's relative to those daily equal lows and old daily lows and projections of the fib. All those ideas come to mind in concert with, in agreement as well, with time of day. Okay, so we're looking at a movement down into around the lunch hour beginning at noon. Okay, creates the important low there, and then retracement during the lunch hour. One more time, it punches above the high here, then it breaks down, consolidates, starts to create 1, 2, 3, and then you can expect continuation going into the afternoon session. We're not going to talk about the afternoon session because honestly, I wasn't participating in it, and it is what it is. I'm familiar with this morning because I had some horses in the race today. Okay, so we'll start getting a little bit more detail here. Here we have the 4-minute chart. The imbalance here. This is one, again, that is not rallying above the opening price at 8:30. Now it's showing 8:28, but that's because I'm showing a 4-minute chart. So don't let that confuse you. But the opening price, again, never got traded above at the 8:30 candle. So whatever that opening price is, 8:30, you extend that out in time, and you want to see that rally above. Now, when you have this expectation, the other aspect of time is the 9:30 opening. That's when the equity market or stocks themselves start trading their New York session. So what happens at 9:30? What am I expecting at 9:30? Well, number one, 9:30 is just when the opening occurs, and there's initial volatility. Now, it can be whipsaw, where it can go up and down real short term, and go both directions in a small range. Sometimes it can be a really large range, and clear both sides of the buy and sell. And then, whatever the real move's going to be for the day, we wait for that to unfold. Today, we can see at 9:30, it just starts to run lower. It doesn't give us a rally at all. So it just starts to speed up what's already in motion from 3 o'clock in the morning during the London Open session. So at 9:30, all it does is start to accelerate down. Okay, and the same idea is being shown on the 3-minute chart. You can see here that indole imbalance gets a little bit more refined, trades up into it rather handsomely, breaks down, and here's another fair value gap with a bearish order block. Now this is one in here where it's useful because you have a little bit more insight as to what it's doing. It's too heavy, it's not likely to rally. There's no reason to look to go long, start looking for reasons to get short, and anytime you get an imbalance and we're above those relative equal lows on the daily chart, because it's going to draw down into that. That's the heaviness objective. Okay, why the prices keep going lower is because they're gravitating towards those relative equal lows on the daily chart. Okay, so go back to the chart where I mentioned in this video and show the daily chart at that little blue line. That's where price is being drawn to. Okay, the algorithm is marching every minute, every hour, every day to that level. How long does it take to get there? I don't know that, but I mentioned in my group that I didn't want to see it happen like we're seeing it right now because it's too fast and it doesn't give a lot of opportunities to get in with it and ride it. So you either have to have entries like this, which unfortunately isn't scalable with the model I've shared publicly, but I do have obviously opportunities to go over it like this and show you how you can still use the idea of the fair value gap to get in with it, but you're gonna have to leave out the element of a rally above the opening price at 8:30. And 9:30 just creates a lot of volatility. Okay, the initial surge in the New York session as these stocks begin to trade basically. So as a recap here before I go into the next slide, midnight New York time, that opening price, I use that to trade the London Open session. That's 2 o'clock to 5 o'clock in the morning. And also to help frame the idea, like say I sleep through London, which is 90% of the time what I do today. Like I don't do a lot of London session trading. And because of that, when I wake up and I'm looking at the market around 7 o'clock in the morning or so, I'm looking at what has happened overnight. And did we create a scenario that I would be looking to trade if I was awake during London? If it happens, then I know that I'm really built in with an advantage on the daily bias, because if I'm bearish and it creates a rally above the opening price, midnight time New York, and it creates that rally, that little Judas swing I've explained many times already, and it starts to decline and I'm below that around 7 o'clock in the morning, I know that I'm likely to create a little short-term rally but it would be ideally above the opening price at 8:30. But it may not do that. And price just remained heavy below both opening prices at midnight New York local time and 8:30 New York local time. So everything was extremely bearish, and it was just so heavy it could not mount any meaningful rallies. Many times in my early development, I got crushed on days like this, where it felt like, okay, it's too low now. It can't just keep going lower, so I'm going to try to buy it now. Because indicators told me they were oversold. 1992, 1993, 1994, I blew account after account after account doing that. And it's frustrating. Now, obviously, with 3 decades of experience behind me, I know what it's trying to do and where it's trying to get to, and it's getting there in a really fast rate of speed. Now, obviously, you can get there a lot faster than that, but I don't want to do that because it gives no real opportunity for me to engage and participate in. And it doesn't give you, as the student, to engage also with your demo or paper trading account to practice. But as real life sometimes is, it's unfair, okay? It doesn't give us what we want. Sometimes our expectations and our wants are denied. And in today's climate, that is not popular. And that's why this market and trading these markets is very, very difficult, especially for like the millennials, okay? That ideal, perfect, always come exactly as I expected, sometimes it's denied. And either you accept that and navigate the markets with imperfection and without the ideal scenario for your model, or you're comfortable with just letting go and not doing anything and being accepting when it comes to big moves and you can't participate in it. There's lots of moves, folks, over the last 30 years that I missed that were huge, big, huge moves. For instance, Bitcoin. I called that thing. I called that thing at 7,500 to 20,000. And then right before 20,000, I said it wasn't going to 20,000. It was 19,700. And I said it's going to go to 6,000. And everybody laughed and went down. And I said it was going to go to 3,000, but it went down to like 32. And then I think a couple times I had it wrong publicly. And then I said that we would go to 20,000 by Christmas. I think it was 2020. And then I said 30,000 by New Year's, and I was off by about 18 hours. It went to 30,000 on the 2nd, I believe it was, in January 2021. And then I said 55,000 and 66,000. That was about as far as I could see it go. And we went just a little bit above 66,000 and hasn't been doing much since. But I didn't do anything with that with real money. So I missed a huge run in something that would have otherwise paid out a lot of money. And I've missed a lot of moves in the futures markets and a lot of commodities. I missed a lot of stock moves, while I was teaching Forex. There's a lot of stock movement in index futures that I didn't participate in. Guess what? It's okay. I'm able to still find trades. I'm not starving. And that's the reality. You're going to have to come to terms and the grip with you have no way of participating in every single move. And don't think that you're going to find every big move. You're not going to participate in every single price swing. You're not going to, folks. I miss moves. You're going to miss moves. And it's okay. It's part of this game. This business is going to still run and do the same things we're looking for all the time. And you're not going to participate in every move. Okay? So give yourself the permission, okay, to be human. You're going to do it wrong sometimes. You're going to see it for something it's not, and you're going to miss that big move. I had a little piece of this today, but I didn't get the whole thing. I wish I would have, but I didn't. And it's okay. I forgive myself for being a good husband, taking my wife to the airport. I know this is all too much stuff and you don't care. Some of you like to say those things in the comments. Get to the point. The point is, you do this, you're going to have these elements creep in. And how are you going to deal with it? You're going to get mad and go on social media and blurt out and curse and say, these markets suck. No, that's not what you should be doing. You should just reason with yourself ahead of time. Say, okay, I'm not going to be able to do everything. I'm not going to participate in every single move. And this is what happens sometimes. It doesn't mean the model's broken. I promise you, over the next couple of weeks, you're going to see the model delivering like it's done in the past. And it's fine. There's going to be times when the market shifts in and out, and the market structure is just too overwhelmingly bullish or too overwhelmingly bearish. In this instance, the bearishness I gave you guys just was a lot more bearish than the model would permit for entry. But you can see there's fair value gaps you need to use to participate. Dropping down to the 2-minute chart, and see again, we find in real nice here, and then once more in here, and then drop down to that noontime, creating an important low, which is what I taught you in this mentorship already. And that 2-minute imbalance you can see on 1-minute chart here and here. Real nice delivery there. And these are just simple little imbalances to get in sync with what is already in motion, not needing to see it rally above the 8:30 opening price because it's not likely to. So it takes a little bit of courage to get in here and trade these types of setups, but that's what you do. Or you don't do anything and you just tape read. You watch it when it does it and say, hey, I would like to see it drop here. And does it drop? Yes. And you study that. And it gives you another fair value gap in here that's not highlighted and it rises up to a bearish order block and sells off. And your stop is above here. And just because it goes down lower doesn't mean jam your stop loss to here, because that's what happens. You need to have time and price behind you before you start moving your stop loss. And also make trades obviously lower into that noontime. All right, so I think that's going to be it. The next episode on Thursday, I'm going to show you a couple things inside the trading platform on TradingView that I think are useful. That answers a few things, and one of the students made mention that could I literally go in and show how to set up the Fibonacci. So I thought it was kind of simple already, but obviously some of you are really, really new and you're not familiar with the TradingView platform, so I'm going to add that at the end of the video on Thursday coming up. Okay, so that way it's at the end, and anybody that already knows how to do it, they don't have to go through and watch all that stuff, but I'll give you another teaching and lesson obviously on Thursday. And until I talk to you then, be safe. All right, folks, welcome back. This is the ICT Mentorship free YouTube mentorship for 2022. Hope you're doing well. Hope you had a wonderful opportunity to study and learn this week and keeping up with the lessons. So we are looking at the E-mini S&P daily chart. This is June delivery contract month for 2022. And I'm going to kind of like bring you back up to speed to what we were looking for over the last weeks or month or so. Remember back here, we had that bearish order block. I outlined that as an area to watch that. And we're entering a seasonal tendency, so we're expecting lower prices. We got lower prices. I showed you the relationship between the dollar because it's risk off. So we have all the decline taking place in the equities markets. And I said that we would be likely to draw down into this relative equal low. So I'm going to kind of like do things in the TradingView platform. So that way, some of you folks that are asking questions in the comment section, like how do I do this and where is this on the platform? admittedly, most everything I know about TradingView, my own students have taught me. So there's going to be a comment posted and pinned by me underneath this video. It'll be TradingView tips. Okay. If you have a tip that you want to share with the viewers that are new to TradingView, please, by all means, just make a post and outline it as best you can. I'm sure they'll be well received. I might even learn something too. All right, so we're looking at how the market did in fact trade down into our relative equal lows. So this was the draw on liquidity. Okay. Now, when I train my students and when new students come to me, the first thing they want to know is how to pick the right order block, because they know it's one of my concepts. They want to know, which is the entry candle. What's the entry point? Where do I get in it? Okay. And that's the easiest thing out of all the learning. Okay. Once you understand what the market's likely to do, where it's going to draw to, okay, where's it going? Why should it get there? Okay. If you do majority of your studying and watching the tape, okay, reading the tape, which is kind of like what I'm going to outline and showcase in the live streams in May. Just before I get any further in this conversation, the live streams will only be in May. I'm not trying to make an ongoing thing of this. I don't want to promise you, an ongoing thing, but I'm going to showcase some things in live sessions. That way you can see how to train yourself to look for these things. Okay. I will not be giving you trade recommendations. Okay. I will not be entering trades in front of you. I'm going to be outlining basically what you saw me do in this mentorship, outlining where this is going to go. And it went there. I'm going to be doing that with intraday charts. Okay. And I'm going to point out certain areas to study. Watch how price reacts right here and look for this type of thing to occur here, because I want you to understand what it's doing. Why is it likely to do what I'm going to outline? Okay. The best thing that can happen is for me to get it wrong sometimes. Okay. So that way it'll disarm you. It'll feel like, okay, well, if I don't get it right, ICT himself didn't get it right here or there. Okay. So I'm going to do my best, obviously, to try to educate you and show you what I think is going to happen. But invariably, there's instances it's going to creep in. It's not going to be accurate. Okay. I'm going to read it wrong and it's fine. Do not take what I'm saying in my commentaries and or my opinions over the chart that's going to be live. Don't take that as trade advice. Do not take a trade. And I'm going to say this every single time I do the live stream. Don't act on it, because you don't know what I'm doing. You don't know what I'm viewing. You don't know what I'm trying to teach you. None of that. Okay. So you want to sit still and just observe and take notes. They will be recorded. They will be on the YouTube channel for those individuals that are not going to be able to be present. When will those live streams take place? There will be a New York session between, I think I'll start around 8 o'clock in the morning. So that way we can get the chart set up. I'll give you my views overnight, what took place and what I think that counter may present, and kind of like build the mindset. I will not be talking in the chat room. Okay. The little chat thing on the side, you guys will be saying whatever you want to say. I don't care. I'm not going to be looking at that because it'll be a distraction. The agenda that I have for that particular day, it will be very distracting for me to read comments and questions. And because I know your question is important to all of you, no matter how simple it may be, I'll feel compelled to want to answer everything that flashes across the screen, and it'll disrupt my concentration. So I won't be looking at the chat. Okay. I'm not ignoring everybody for the sake of being rude. I'm just ignoring everybody so I can stay on task. Okay. So there's that. But we'll begin around 8 o'clock in the morning, and we'll close it, whenever I feel the need to do so. But I'll be willing to go up to 10:30, 11 o'clock. Okay, which is a very long session. I know. They may not all go that way. I won't be doing it every day either. So it'll be a hand-picked selected day in advance that you'll know about, and I'll post it on the community tab on my YouTube channel. Okay. All right. With all that stuff out of the way, let's get back into the nitty-gritty here. So I outlined this area here in this low, and I said this would be the draw on liquidity. So when you're on TradingView, over here there's a little segment where you can have a choice of certain things. Now you can do this, so it looks like this is your bullseye where the market's going to draw to. You're aiming for that, in other words. Or you can use a little magnet icon. I teach with that analogy. Like up here, imagine a magnet of some kind down here, and price is going to be drawn down to that level here. So this is where the liquidity was, and they tapped into it today, right? You know about it up here. You know about the order block up here. You know about the seasonal tendency I outlined, and we have this really nice decline here. So I'm going to take you into the marketplace and strip this down a little bit and give you some more details. So we're going to the hourly chart. And this is why I do PowerPoint slides. It's real easy to get to where I wanted to be. All right, so we had a run here. Yesterday, just kept pumping higher. Just fell short of this high. And then so we had a decline, and then the normal pause. And they gapped it down, then rallied back up. So between this candle's low and this candle's opening, right in here, that's an imbalance, coupled with an actual gap. So I want you to take a look at that. Okay. Now, we have this candle here, small little piece of that one here, this one, this one, this one, and this one. They go just above that area here. This is permissible price action. In other words, this is something you have to get used to. Okay. Look at the bodies of the candle. See how they're staying inside of that imbalance? It reaches for liquidity and stops on these wicks. But the bulk of the volume is being held inside this imbalance. Notice that? So now we have the market release go to the downside. And then here is 9 o'clock in the morning. I'm going to go into 8:30. Actually, just go down to a 15-minute chart. So here's 9:30. That opening price here. At 9:30, what's actually happening is the equities are opening up. The stock market starts trading. That's when you hear the bell ding, ding, ding. Sudden everybody's clapping their hands on TV, whatever. That's what's occurring here. It's opening. So it's running a short-term high right here, and then breaks lower. Creates an imbalance here. So on the 15-minute time frame, what do we see? Did it take a high out? Yes. Did it break below low? Yes. Was it displacement? Yes, it was energetic. Did we trade back up into it here? Yes. So in here, you could be a seller and get in sync with a run. Try to get positioned for, if you are a swing trader or short-term trader, this could be your entry, and aim for that old relative equal low, which is that blue line here. Remember the 2 equal lows on the daily chart? I drew a line on. That's what this is here. Okay, and it ran down into it today. At 8:30, right there, we're using the opening price Did price trade above it? Yes, it's in premium. It's above an old high. That makes it a premium too. I believe it was a young lady, and I apologize, I don't recall, and I didn't make a note of your name, so please don't be offended. I know I saw it where it was saying something to the effect that you don't understand how it could be in a premium because it's above an old high. Anytime the market trades above an old high, that is a short-term premium because it's going into liquidity. Anytime the market trades below an old low, that's a discount. Okay. Now, just like the purposes of what people use overbought, oversold indicators, things can be overbought and still go higher. Things can be oversold or in a discount and keep going lower. Okay. So that's why I'm suggesting that when people are studying price, they can't just assume that an indicator is overbought, so therefore it's a good sell or a shorting opportunity. It's not always. But if you understand the narrative within market structure is not the answer. It helps you frame an idea, but the idea must be in alignment with the present narrative. Narrative is why should the market go where you think it's going to go on that particular day, based on the climate, the economic calendar events, and the volatility that's being offered for that particular trading session or day. So these are all things that you're going to need to study, and I teach on this YouTube channel. And I'll teach a little bit more when we're doing live sessions because it'll be more practical then. So you're over my shoulder, you're looking at it just like I'm looking at it, and I'll give you my internal dialogue and kind of like what I'm thinking that is the most salient at the moment. So that way your attention is on the right things at the right time. But power 3, which is the open, rally up or manipulation, creating a high, and then the movement lower, and then distribute their shorts below an area where there would be stops. So smart money would be selling short the buy stops here, writing this out, and offloading their shorts to sell stops below those relative equal lows. Remember, when we see these relative equal lows on the daily chart, traders are going to look at that as a breakout. There's lots of traders out there that have long-term trend following systems and models, and if it breaks below those areas, they want to be short. So that's going to flood the market with what? Market orders to sell at the market. Well, that's a perfect counterpart to smart money being short up here because they want to buy it at a lower price. And while up here, they're aiming down here. Is it hard to believe that when we were already outlining that last week and the week before? No. We have visibility. We have the ability to forecast certain things that should repeat. If the algorithm is in fact in control and we understand what the algorithm is doing, and I'm suggesting that my experience should indicate that we have that, does it deliver? Here it is. Okay, so you're taking the logic of certain principles and concepts and blending them with market structure. We're looking for lower prices, it should reach for a specific low, but also how does the present narrative allow for engagement with the daily range or power 3? Everything I've taught you. So it's the open rally. Smart money enters near the high today above the opening, and you get out down here at an important low, and the market closes near the low of the day. Let's go into a 5-minute chart. 1, 2, relative equal highs. You see that? Now, if you're looking at the lower time frame charts, let me get this off here. It's no longer useful. If you're looking at that like that, here's the opening price. You know there's what resting above that? Buy side. So buy stops or buy side liquidity is resting here. So it can run up, and just to the left of that, also, you see these highs here? They're real close to one another too. So for good measure, they might want to come up here and clean that down. This is a little too much. I think it's too rich for the expectation to get to that high. But in here is reasonable, but here at least. Okay. Market punches up through. Yes, it does take those out. Then it breaks down, comes one more time back above the opening price, and gives up the ghost and aggressively runs for the sell side below here. Now, for some of you, that would be enough. Getting short up here, buying it back below the lows, and being done and walking away. There's nothing wrong with that if that's your model. But we're going to take a closer look inside of this area here and see what we see. All right, let's drop down into, I'm just going to go right to the 1-minute chart just to save time. All right, so we have in this area, the market ran above those relative equal highs. Here they are here. Market runs up, then it breaks down right here. See that right there? That's a swing low. Breaks below it. Was it displacement? Yes. Does it mark come back up into this little area here? Yes. Is it above the opening price? Yes. Is that enough? Sure it is. You can be short there. You have to weather this one more run up into your entry, and you may have a little bit of drawdown. But your stop loss, if you're entering this fair value gap, your stop has to be above the very minimum. The candle that creates the fair value gap, that's here. So your stop's going to be above that. For good measure, conservative, up here. Oh, ICT, that's a lot. That's a big stop. Well, look how volatile it is. You want to be knocked out of the trade prematurely, or are you just concerned about making the maximum amount of money on your trade, dismissing the level of risk? That's what gamblers do. I'm not trying to teach gambling. So when you practice on your demo account, keep that in mind, that you're not trying to overextend yourself. The sell side below these lows in here, after it hits the fair value gap here, and then one more time into it, below the opening price, it breaks lower and aggressively runs below here. So not a bad little run there. Let's go back up to a 5-minute chart. Okay, and we're going to go look at the afternoon session. Here is 1:35, and I remember I stated that around 1:30, that's when I like to go back in. Now, I've taken trades earlier than that, but I'd like to see 1:30. After 1:30, the lunch hour has been smoothed out, and then there's usually some kind of a retracement higher when it's bearish or retracement lower when it's bullish, and you're seeing that here. The imbalance, relative equal highs, it runs up into that right there. That's an area you can get short on. Market delivers a run lower. Here's another little fair value gap in there. It runs up into that. That's a short, aiming for what? That line here. That's that relative equal low on the daily chart. So today, huge, huge opportunity day. Lots of points that could have been made available. But I did something this morning showing everyone kind of like what reading the tape examples will be like when I'm doing the live session. I did some executions just to prove visibility, to prove I was expecting a certain run, and I believe I was in NASDAQ. Yeah, I was in the NASDAQ. So let's go over to NASDAQ. Okay, that's in here. So we're going to zoom in here on this bit of business. and here is what I had in mind when I was looking at the chart. Woke up this morning. My wife is out of town with my daughter, so I woke up and just because, creature habit, your spouse ain't next to you, so I had insomnia. So I sat up and I was looking at the chart. I said, well, you know what? I see. Well, let me ask you what you see before I do it, okay? What gave me the backdrop for all this in here, which I'll explain in detail in a moment, but what gave me the realization that this is likely to turn here to lower? Study the entire fractal that's being shown, okay? Pause the video. Some of you just refuse. I'm never going to do what I see. Stop asking me to do it. All right, so we had this high here. We ran above it, and then we had the market shift. So buy stops taken, breakout artists taken in on the market long, and then relative equal lows broken. So we have a shift in market structure on a 5-minute chart. In a time when it's bearish, we're looking for those relative equal lows to be tagged on the S&P, and this is not the S&P, I understand that, but the expectation is we want to see these two indices go down on the daily chart. So heaviness should be the protocol going into our trading day. In here, we have what? Displacement below these lows. So we have a lot of energy there. So right above that, what do we have? Fair value gap. Well, there's one right here too. Right. What does that teach you? This is where you do your entry. But ICT, you didn't enter here. Right. I wasn't looking at the chart yet. I'll get to that. He's in my mind. Can you read my mind? This fair value gap here, we expect that to stab up into it. So our stop has to at least be in a position where it can weather that. So what does that mean? That means that you have to either have deep pockets and allow for your stop loss to be inside this here, or you use the micros, which is fine. I don't do a micro, man. I'm going to be in here $20 per point. Okay. But you have to have an account that will allow for that. If you don't have that, then trade micro. But I don't want to do that. Okay. Gamble. But not because I taught you to do that. So here is the order flow inside of that fair value gap here. Again, a little bit of extra runs above into that fair value gap there. I'll put another rectangle so you can get a visual representation of what I mean. I mean, you can clearly see it, obviously, but I want you just to see it by contrast. So this is the rules. This is why I've been teaching you. Okay. If there is only one fair value gap, then you just put your entry there and you don't expect it to go up into any deeper retracement. But because it has another one here, expect it to stab up into that. Now, I know some of you in here want to be an ICT junior and you want to be in there on the highest candle when you're selling, you want to be on the lowest candle when you're buying, and I understand. But this isn't always going to happen. So if you're really only trying to aim for that, you're going to miss moves. And if it moves like it did today, that's a heartbreaker because it moved a lot. And if you weren't positioned in it and you spent the rest of the day kicking yourself about being greedy, about trying to get that instead of where I've already taught you, you'll probably miss the other moves that take place later in the afternoon and you get nothing for the day. All right, so anyway, so we have a shift in market structure. We move up into a fair value gap here, and we have a break lower, fair value gap here, relative equal lows. Now look real close, folks, okay? Relative equal lows, a high being taken here, we break down, these two candles move right below here. That's the same thing as these two candles here being broken with this move here. It's a fractal. This whole move here is the same thing here, just smaller, and it creates the same thing. The fair value gap here, the market trades up into it, the body's kind of respecting that low area, moves a little bit above it, that's fine, but then breaks aggressively lower. Does it take out the low yet? No. Retraces up in. Now I have two, okay, not one, I have two narratives in play. This one here, where we have a shift in market structure there. So this is a long-term high. Here, we have another break lower, we went in balance, so it's intermediate term high. This is a bigger one than that one, right? So this is a long-term high, intermediate term high. By definition, they're both intermediate term highs because they have imbalances. But this one's lower than this one. And this over here is lower than that one. So this is a turning point, making this, by the hierarchy of swing points and market structure, this is a long-term high. Intermediate term, because of the imbalance. But how they mesh together for market structure, long-term, intermediate term. Now, when this is retracing up, this is going to be a short-term high inside of a market structure that is really predisposed to go lower because we have long-term and intermediate term above me. This should respect the underlying order flow and go lower. And I'm looking for that lower price that's below here. There's sell stops resting below that. So as it retraces back up into this up close candle, what is this up close candle? It's a bearish order block. That's not what you've been teaching us, Mike, on this model. Right. I didn't say that's what this was. I'm telling you how to read the tape, okay? But I do teach order blocks on the channel. So we're going to go into this right here. So inside this shaded area, this is what I'm going to be executing in. Not with that color in. Okay, that's good enough. May not be your choice, but it's mine now. All right, so we're going to drop into a 1-minute chart. Every time I do this, I always imagine somebody has a little bit better understanding how to work with the TradingView platform. They probably have a whole lot easier, quicker way of getting to where I'm trying to get to. Sorry. All right, so we're inside of that blue shaded area on the 5-minute chart. I'm also inside of this green candle here. That's a bullish order block. So what I'm doing is now I'm going to calibrate, which just simply means I'm going to go down and, with a top-down analysis approach, refine that order block that was on 5-minute down to this one. So the market retrades back up into here, into that order block. And I'm trying to aim, once it hits the midpoint of it, I want to get in around that time. Okay, so I'm entering there on that candle, and then I'm holding in all this, and it drops back down. Now, some of you might look at this and say, oh, but this is that order block, fair value gap here, and what happens if it rallies? Well, it does a little bit, but what's it subordinate to? All the things I outlined over here, and on the 5-minute chart over here with a higher swing high. So the market structure is bearish. I'm not looking at this setup. This is why I'm telling you, I tell this all the time, okay, is me teaching my order block theory, me teaching my fair value gap concept, is it going to become ineffective? No. Because number one, it takes a lot of discipline. You have to be absolutely organized. You have to know what you're doing. And that's why a lot of people just teach it from hindsight because they can't really do it. So you can sound real smart, you can sound real educated and institutional, quote unquote, but if they can't do it, it's useless. So if I'm showing you these things and I'm telling you also, look around, majority of the people that parrot what I teach That means they're mimicking by saying what it is I already said, like an echo, but they're really not doing it. They're not doing it like I'm able to do with it. That should be your comfort. That people, by far and large, humans are lazy creatures. Okay, they're lazy, and they're not going to be predominantly rule-based, disciplined, responsible. They're going to be lazy, and they're not going to do what's supposed to be done. So it won't change anything. Okay, it won't make these things inferior. It won't change their superiority. It will not make them ineffective. They will remain constant. Now, the algorithm. I don't care how many people learn from this YouTube channel. Okay, I don't care how many people rip me off and try to rebrand and change the name of everything I've taught. All of that saturation will not change because what I just said. The algorithm is going to change. There's new suckers coming in all the time. P.T. Barnum said it really, really accurately. There's a sucker born every second. So you're never going to run out of liquidity. Somebody's born, somebody gets old enough to start speculating and trading, boom, they're in the marketplace. And that liquidity will just add to the liquidity that will be on the other side of your trade. So there's no reason for you to be worrying about whether or not this is going to be in effect. I've been teaching this for a long time, okay, privately. And listen, if I honestly believed in my heart of hearts that this would fail and stop working if I taught it, I would not teach it. I wouldn't. I would have never even mentioned it. And I'm being honest. So take heart. There's no reason for you to be upset about or worried or concerned. It will remain. As long as the markets are trading, these elements will be in these markets. There it is. All right, so the market rallies up. It stabs above the order block here, but it's just a wick. See that? The bulk of the volume and the bodies of the candles are inside that order block. Then the market does what? It breaks and shows displacement here. Remember what I said about this pattern here? Relative equal lows, it breaks down and it goes back to a fair value gap. Here it is again, relative equal lows, displacement, fair value gap. What does it do? Go right back up into what? The fair value gap. And look closely, the bottom of the bearish order block. See that? Bam, hits it. You watch me looking at the chart. It's there, and I'm entering on that candle. I'm not entering it because I wasn't really looking at the screen for a second when I was holding the phone this morning, but I wasn't looking at it here. This is the one in the chart. I was doing something else. Then I looked back at the screen. I seen it went up there and hit it. And after it filled it, then I put my market order to go in and sell 2. I sold 3 contracts here. I sold 2 contracts here, and then I entered again here. After it did what? Retraded back up into this bearish order block here. So it moved down, came back up in, and I'm selling short here, there. Okay. What's the low on that candle? Right here. Look at this figure right there. So 13,334 and 3/4. And my entry, as it ran up into it on this candle, the entry was 13,335. So it was only a quarter of a point above into that candle. That was my entry. It had a little bit of heat here. So on that entry, it was 1 contract here. So notice what I'm doing. I'm entering at the largest portion of the setup, or the framework for the trade. I'm going in with a maximum position size, first 3 contracts there. Then selling 2 here. And then I'm adding the last one here. At logical, precise areas. It's not randomness. It's not willy-nilly. It's just not flipping a coin. It's not guessing. There's logic here. Okay. So when the market has this heat on it here, the highest value that candle goes to is 13,339.5. So 4.5 handles. That's the heat I took on that there, but only on 1 contract. Okay. Because I have 2 contracts that I'm short from back here, and I have 3 contracts short from over here. So I have all this built in equity with 5 contracts. So the 1 contract here that only has 4.5 points of heat on it or drawdown, it's insignificant. I don't even worry about it. I'm not thinking about it. And that's why when I pyramid and I build in large positions, I'm starting with my biggest position first, and then I'm going smaller and smaller until I can't do any smaller. I don't ever do the final 1 contract and do 1 more and 1 more and 1 more. I don't do that. I don't need to do that. So once I had that position established, then I submitted to the idea of it going down to that level that I drew out on the, I forgot what time frame was now, but we'll draw back out in a second. Here is the exit here. I'll put all 6 back at 13,285 even. I want to be just above the level because it might do these little shallow runs and it might not give me my fill. It does a little bit of that in here, and then finally digs a little bit deeper. I just would have had to wait a little bit longer to get the fill, but it happened right there. And I posted on the community tab when it happened. Boom, and showed you a little screenshot. There it is. Now, that's reading the tape. That is reading the market. That's getting familiar with order flow. And for those of you that are students of mine for a longer time than just recently, you recognize this as a market maker sell model. So I was selling in an area where distribution would take place. So all this stuff is there. It's logic. I'm going to say this point because I know there's people out there going through my trade statements and you're looking for precision. There's a lot of things I'm doing in that in those statements that have nothing to do with trying to be precise. You guys want to see an account go up. I provided that. I also provided a way for my students that were asking me that I'm obligated to show them where if they went into a period of drawdown, how do you fix it? And also had lots of questions like, and I did it this morning with, let me see, where was the entry at? The second one where I did 2 contracts right there. Okay. When I did that one, it was after I did the, or what did let me go back and, well, the one where I had the fair value gap, so I didn't see it when it was forming and filling it in. After it filled it, it was still close to it. So it was a close proximity entry. A lot of the trades in that TD Ameritrade account, I'm using close proximity entries. And I'm also using things that you don't know about. Okay. I'm also proving to some of my students where if they got into a marketplace and they take a trade and they don't get stopped out, but they sit through drawdown, how to weather that. You are not privy to the conversations I'm having with these students. So don't assume that you're looking at those statements thinking, oh, this is all he's got. That's not all I got. I'm actually doing something else. There's somebody out there talking, saying they can do things and I can't trade, and I'm baiting them. I want them to step out, but they won't. Okay. I want them to think that that's all I can do. And even then they wouldn't budge because he knows I can do better than that. This is not even the best. There's other things you can do with my concepts right from this YouTube channel that's more precise than this. I know it sounds hard to believe, but it is what it is. I don't want those statements that I'm sharing because like everything else of mine, people take my stuff, remove my name, rebrand it, and they say, this is my stuff, this is my creation, this is whatever, and they sell and they scam. If I give statements that have real time and sales with live account, and I'm producing like you see here, is it hard to imagine someone taking that and showing it to people and saying that's their results and scamming them? think about it, folks. Everything I do, there's a rhyme and reason for it. I'm not reacting to someone else's negative discord. So today, this is the last of the business here, and we're done. So I did all this overnight, going into a pre-New York session. Then we had all this back and forth. They pumped it up over the overnight high here, and then we go back into that discussion we had earlier. So they ran the high here with this run up, and at 9:30, that's when we expect that volatility to come in, and that's right here. Okay, so a little bit of whipsaw in here, boom, rallies. In my live trading account, I took a long in here, and I got out at, I think it was 13,409. I wanted 13,425, but I was a little apprehensive thinking they may not stab through it. They were getting real close to it, and it's hung around. And I got out just a little bit prematurely, and that was it. And I didn't take anything until later on in the afternoon. So a small little scalp in here, maybe about $740, I think it was. And that was it. My attention diverted because I'm Mr. Mom right now. My wife's not with me, and the 2 children I have that live with us still. I'm in charge of homeschooling them still and running this business, and I have 2 boxers that are highly demanding of my time. And I know some of you are saying, get to the point, get to the point. The point is, I'm a real person. Okay, so I'm not able to be in every single move because I'm doing other things, and I have a life. I know it seems like I probably don't, but I really do. And as introverted as it is, and as simple as it is, I love my life, and I like doing the things I like doing in my life. But the markets are not everything in my life. But hopefully, you got something out of this, and you can see how we did again. I'll draw lower on NASDAQ, and I think that will be it for this one. I'll go back to evening S&P, and you can see your relationship there. So both of them moving in concert, both of them moving in tandem, but look closer. Okay, this is why I went back to evening S&P. Why did you do that, ICT? Do you see that? Look at the high here at 2 o'clock in the morning, 2:30 in the morning today, Friday, April 29, 2022. The rally here after 8:30, it creates the high, but it's lower than the high at 2:30 overnight. Now go back to the NASDAQ. See that? 235, and we have a higher run on NASDAQ. So this is what I teach as SMT, okay? It's showing a willingness to crack the correlation between like markets. These are closely correlated assets. The S&P 500 stocks composite and the NASDAQ 100 stocks composite. They generally move together in tandem, not all the time. So if we're bearish and we're expecting lower prices, and we see this, but the S&P doesn't do it, that's showing you that this is a stop run, and it shows that S&P is really weak. So this gives you confirmation without using an indicator, okay, without having anything on the chart. It shows you, let me just do it here. When you have the NASDAQ like this, you can do a compare and contrast by hitting this little tab here. And we're going to add this evening S&P, new pane. So it plots it below. And then if you're comparing highs, you want to go over here, go to the little gear, price source, you want to change that to high. And you can see high to high, high to high. Higher here, lower there. So it looks like a divergence, you see that? With an indicator. But it's not an indicator, it's price. So I use intermarket relationships and correlation used properly. There's a lot of people that are talking about correlation, they have no idea what they're talking about. But if you look at the idea of this relationship here, it gives you like an X-ray view of real accumulation and distribution. This is distribution because it doesn't see the same rally higher that the NASDAQ did. Okay. There was 2 other things on my agenda here. I mentioned to one of the young ladies I would show the fib. This is nothing else, so you guys are all welcome to turn the video off because this is not going to be teaching really anything. It's for those individuals that just want to calibrate their Fibonacci and also some of the points that I add to the chart. And I'll show you what that means here. Price note. I had someone ask me how do I put those little annotations on. Just anchor to the high you want, drag it over. If you hold down the shift button, it'll make it level. You can also do that with your trend lines. So if you want to add here, you start dragging it. If you put the shift button, it'll automatically toggle it and keep it straight. And so many of my students were so helpful because it used to drive me crazy. So anyway, I know. I warned you folks, it's not going to be arm burners. It's simple stuff for people that are new. All right, the last bit of business is the Fibonacci. Okay, so I'm going to anchor your fib to 2 price points. Get this off here. All right, so once you have it on your chart, highlight it, and then go to the little gear, and go to style. In style, these are the settings. Okay, all you do is go in, put the little box here, type in the numbers you see, just like I have here. Now, if you want to see projections on how far down or up the moves will likely go, this is for equilibrium. So if you want to see discount the premium, that's what the 0.5 level is, it's 50%. And you can see by having this on here, it starts doing standard deviations. Okay, and if you want to calibrate it to the daily range here, it'll give you a pretty good idea of where your low should form. Now, this was a little bit excited because it went below an important low, but that's enough for government work. If you want to show the optimal trade entry levels, and you're pulling the fib up, I'm just taking this off so that your attention is great on the levels that make optimal trade entry rather. The 62 and the 79. Okay, and you can change these, make them a different color to stand out. I don't like to do that, but you can see it here. So if we were looking at it like this, here's the optimal trade entry levels, and it trades up into it here. You zoom in. Can you zoom in, ITT? I ain't young like you are. All right, so here's the high to the low. Optimal trade entry, trades up into here, and into the fair value gap. Bam! That's what makes it optimal. So there's your entry here, and you can start going back in. And we can do the projections here again. Go into it now. Move this out of the way. Do 1 standard deviation, 2 standard deviation, 1.5 standard deviation. And I think that's enough for this one. So the range from the high and the low, you can get that for your discount the premium. But for optimal trade entry, I like to use the bodies, lowest open or close, in the swings. And you can see how nice that gets right up almost into the 79% trace amount. You see that? I'm going to take this sphere I got. You see how it cleans up. What do you think what the books say? ICT don't know how to use a Fibonacci. You have any idea how many people said that in the years? They actually made videos about you on YouTube saying that stuff. Look at this, I don't understand what he's doing. It's the bulk of the volume. I'm using the lowest opening on this candle here inside this swing. And inside this swing, I'm using the highest open or close. And that's what's being plotted on. Optimal trade entries here. I look at this as stop running, just like this is. I want to get to the heart of the matter. Okay, I'm getting to the point. This is extra for the people that didn't want to stay. So the optimal trade entry level here. Now if we start looking at the projections down here, we have one standard deviation down here. Project that over here. Boom. See that? Hits it, and then we have a nice retracement up. So this was a good area to take profits here, and it's also below the low. So how far can it go below this low, ICT? Well, there's a standard deviation right there, and it does so handsomely. And we have a nice little retracement. Then it gets wild right before the opening. Okay, but that's the things I promised it would be at the end of this video. That was supposed to be on Thursday, and I appreciate you guys being, patient, not going all crazy and pitchfork and torches. You said you were going to do a video on Thursday. Real life kicked in, folks. All right, and I think that, my friends, is going to be it, and I will touch base with you, Lord willing, on Tuesday of next week. And so I'll talk to you then. Enjoy your weekend and be safe. All right, folks. I'm going to take a look at the E-mini Micro NASDAQ 100 index. Okay, and I'll show you the imbalancer in here. This is the initial one. You can always imagine it could stab up into the second one, which is really essentially just done now. So that could be a sell. I'd like to see it come down here first. I'll outline this as I go. This is kind of the end of the road for the drop down before it runs Tuesday's highs. That's what I'm thinking. This is FOMC. I'm going to do a few minutes for it to do its initial shakeout. So this is the end of the race lower. That's a little checkered flag. Notice I have that. So it's not like me talking after the fact. You can see I'm doing everything here. There's where we're looking for it to drop down in and run out the Tuesday highs that I was mentioning on my community post. So I'll look for the trade down here. Now it could sweep a little bit below that because to the left of that imbalance that I'm highlighted in turquoise, there's the south critical resting just below it. But for now, I'm just focusing there. So it could drop down into that level. Now, there's a couple ways to use this information. You can do a trade here with your demo account, compliance reasons, and look for it to run out the short-term low, or wait for it to potentially trade up into the higher time frame fair value gap. And the reason why you could potentially wait for that is because it's FOMC. It has like a knee-jerk reaction, kind of like non-farm payroll. There's an initial leg, then another leg, then like a fake-out leg, and then a real setup comes, which is what I'm outlining here in that blue shaded area. So I'm noticing that it's likely to draw down here, so I'm drawing this out so we can see the diagram is dropping. Okay, the idea is to drop down here first. This is the quick move I'm looking for, then to run through Tuesday's high. All right, so it should start dropping in here. I don't want to see it go too much more than that because that would upset the fair value gap that is not yet traded into. I think that's going to be the next real drop. So right here's where I'm thinking initially. There's sell side resting right below that low. So you could be a short here. And your stop would be right above that most recent green candle to the left of where we're at now. And you can see there's no replay button being used here. The candles are painting. The replay button is dim. It's not even a thing with me. Well, that's not true now, is it? I did recently in the mentorship video use the replay button, but it felt awkward enough to do it just to be funny. So here's the drop down in here. And I can revisit the bottom end of that fair value gap and bump it, kind of like a support resistance idea. And that would be a shorting opportunity if it were to do that. And again, the stop would be placed at the high of the most recent green candle to the left. Right there. See that? That's a short right there. Okay, the market is likely to keep dropping here. I'm looking for that little bullseye, that blue bullseye right below that short-term low. And that blue line, if you notice when I first started recording here, that was really just an order block. So it could bounce there a little bit. But ultimately, my interest is from where we are now down into that checkered flag area. And it doesn't look like I got enough room, so I'm going to probably have to move that over to the right a little bit. And again, the mindset is we're dropping down. Okay? Even though it's really initially just ran the Tuesday high, but it's done shallow. Okay, the vocabulary I'm using here is running the Tuesday high, not sweeping the Tuesday high. The difference between sweeping would be like what it's done here. That would be a sweep. That's a real shallow little run above that red line. That's Tuesday's high. Okay, so it swept that, and then we're coming back down post FOMC. So kind of like look at this move here we're making, and if it can drop down to that blue shaded area, it might just, if I'm wrong, it might just go down to that little bullseye and then run higher from there. I'm hoping it doesn't do that. I want to see it trade down into that blue shaded area, where it'll checkered flag is. So that's like the end of the race for bears. They get into that, then it should start the real move higher, running Tuesday high. Running Tuesday high means it runs right over top of it and it just doesn't look back. Sweeping is where it just goes above or below or low or high. You know what I mean? Like if we're going to sweep high side, that means it's going to go up a little bit and then go down in reverse. Okay. If I'm saying we're going to run an old high or relative equal high, that means we're going to run through it and continue. So here's a little bit of understanding here what I'm saying when I say that. I try to pick my words carefully so that we understand the distinction between what I'm expecting as a sweep and reverse back into the range or expansion move, where I think if we can get down here, I'm going to scrub this over because you can see we're running out of space here. It might take a little bit more candles than I first thought. Yep, let me get this back here. There we are. Oh, there it is. This thing, I'm telling you, I look like a noob. I see this noob. All right, so we'll see if we can drop down into that. And I have to make another video for my mentorship group, so I got to get started on that one. So here's a bearish order block. You can come back and hit that and resume going lower. All right. Not bad, not bad. Let's see if she loves me. You can see, no replay button. Everything's dynamic here. about to run into that sell side liquidity pool. Just anchor this here so you can see visually when it drops below it. Change the color here so a little bit lighter than that one. Oops, too light. Yeah, that's good enough. So we can see it. I'll take this off here. All right. And there you go. Now I'll come back to this in a moment. All right, as you can see, the market did in fact trade down. Look at the bodies of the candles respecting that blue shaded area. Really, really handsome price delivery. And it dipped down a little bit below, but that's fine. I'm not worried about being that accurate. The main thing is going down into that area, it turns and then runs Tuesday's high. Look how much more dynamic that is. Now, what I did was I took the low at the turn after it made its run into that little blue shaded area. Once it started rallying and it took out the swing high around that 13,150. Basically crossed back over where the fair value gap is, the larger one it dropped down into. Once it trades above that, then I'm going to use the high initially at the 2 o'clock hour down to the low post 2:30. That range I'm using the Fibonacci to expand up to a target, and it came up to 13,437 even. I'm just waiting for it to hit that, and once it does, then I'll go into the Fibonacci. I'll show you what this looked like, how I measured it, and all that. But hopefully you can see that it's done the majority of the move, which was outlined on the community tab before I obviously did the video. I did the video here, marking it up that we can see it wasn't a replay thing, it wasn't something after the fact. It's something that I'm teaching you all here. Now, the question mark at the bottom lower left-hand corner, what that's anchoring is the high that was formed at 2 o'clock, or what would be shown as 1400 here on the chart, down to that low where the question mark is. So what you're doing is you're doing a measurement of the range. Okay, where's 50% of that? Below 50% is where that fair value gap is. That's in turquoise. So that's the target's dropping down into. So it's a matter of looking at this. And really, there's technically, there's 1, 2, 3, 4, 5, 6, 7, 8. There's 8 trades in this whole entire thing. So once it trades this level here, I'm looking for it to hit that, and then I'll go in and kind of show you some things about what I'm referring to as the 8 setups. And this might not be the real setup that you would be looking for. It might be one of the 8 that I'll show you. But that's the unique idea that I want you to adopt as a student of mine. I don't want you all thinking, well, we all have to have the same setup. No, you don't have to have the same setup. In fact, you're not. You're going to come to the conclusion that the things that you're looking for are going to be much more important when it's uniquely selected, not me pushing you into a mode saying this is going to work every single time just for you, because it's not going to work that way. So you have to find a way to grow comfortable with the concepts and how that applies to the present market conditions and how you select your setup. And I'll show you 8 of them in here. That way you'll know that this is what you're looking for and it fits your criteria. And you may not take any of the other 7 out of the 8. But the main one here is obviously the one I highlighted. It's the one that is the highest form of analysis that we can see exactly where it's going to draw to before it turns around. So you can couple what I've shown you here with what I've outright came and told you basically that I'm looking for to drop down to FOMC at 2 o'clock. Once it drops down into that, usually around 2:30, it's finished its initial leg where it prices in whatever it's going to do, either high or low, and then starts to rally. So you can see it's pretty much close to that in terms of algorithmic delivery. I'll just look at past 2:30. We're about ready to hit that target here, and there she is. All right, so let's dim that out, and I'll take you over to the fib portion. I'll explain everything to you that way. All right, so now obviously I'm going to take you back in. I'll use the fib here, and what I'm doing is anchoring to the high down to the low. Now this is the most extreme. Now usually I'll use the highest open or close and the lowest open or close in the price swing when it's not expected to have a whole lot of volatility, because it's the FOMC. It's more likely to be much more volatile. That means the extreme of the ranges should be considered. That means now I'm going to use the wicks. You get asked a lot all the time, in the comments, like, why does ITC use the wicks and why does he use the bodies and why does he differentiate? I just taught you. Okay, so I'll show you 2 forms of that. And actually, this backwards didn't. I'm going to draw it from the low up to the high. I'm looking for upside objectives. Okay, so low up to high. Here's 1 objective. Here's 2 objectives. And now we're just falling short of that one. Okay, so that's kind of the extreme target for me today. But if you look at the body to body, it'll make a whole lot more sense in a moment. There's that target I was looking for right there in the earlier portion of the recording. Okay. Fair value gap. Initial one here drops down, hits the order block, which is that blue line here. It bounced up into the fair value gap. This is what I was suggesting. This is going to be the main one. So it's a run on liquidity, drop down, start to drop even lower, hidden order block, then rallies up, hits the fair value gap. That sets the stage for the decline down into the area I highlighted in advance. Said this was the end of the road for bears. Starts to rally, comes back down in, rallies once more, takes off, takes out Tuesday's high, much more meaningfully, and rallies again, pulls back into an imbalance here, rallies again, pulls back into an imbalance here after taking our target, and even continues to go higher from there. Okay, so let's take a look at some of the trades. You got the run here ahead of FOMC. That I would not count. Okay, that's a setup, but that's a gambler's. So it's before the FOMC announcement. So we have the drop down, then the fair value gap here. So that's trade 1. The return back to the fair value gap here. That's trade 2. Drops down in below here. You close your short if it's a scalp. Here is a long idea as a scalp. It takes us up into offset liquidity resting above this high here, and then into the fair value gap that sets up the short down into the objective I was looking for. Now, right away, some of you are thinking, man, I'm not Spider-Man. How do you expect me to take all these trades? I'm not, folks. I'm not. Any one of these things that I'm outlining here could be a specific setup that fits your unique model, okay, that meets the criteria that you're looking for. Then drop down here, that's a buy, and you can show you this here as an order block there, rallies up, and it comes back down into the order block with these 2 down close candles here, because now this is where I said we were going to turn, and I said that we were going to run Tuesday's highs. When I sweep them like this, it's going to run them. Okay, so we ran right over top of them here. So it rallies up, comes back down in, retracement, rallies again, small little imbalance, you can be a buyer there, rallies, and again here, this is one that I didn't obviously mention, or see, because I stopped the recording as it ran through here on our objective. Okay, and I think that is going to be it. So I don't want you thinking this is an invitation for you to try to trade FOMC or like a non-farm payroll event. They're very, very risky, extremely risky, but they're really fun to go back into and study from a hindsight perspective. Or if you can watch it live, it's a wonderful case study that we can look at how the liquidity's taken, how it runs to the other extreme of the range, and how it starts to deliver institutional order flow. All down close candles should be supporting prices as it goes up and running out Tuesday's high in a much more meaningful manner. Hopefully you found this one insightful. Until next time, be safe. Hi, folks. Welcome back. This will be episode 24 of the continuing series of the free ICT mentorship on YouTube for 2022. All right, so I want to kind of like sit you down for a minute, get your attention, because if you don't have the proper mindset for this one, this could be taken out of context and viewed in a light that is not really my aim, okay? So I want you to think about, why are you even watching these videos? Are you trying to learn? Are you just entertaining yourself? Or are you here to try to be disruptive? Because if you're trying to be disruptive, I don't have any time for that. So I want you to understand what I'm going to show in this video. This is not going to be a repeating theme. I just want to let the foundation be laid here. If I see any comments that are either disrespectful or just meant to stir up chaos and create a ruckus, I'm just going to ban you from the channel and your post won't appear, okay? The comment section is open. You guys said I don't open the comments up. I've been opening them up. All mentorship videos are open, okay? I use your comments to steer the future direction of the lessons. I try to incorporate things that you may have asked or shown a concern about respectfully. If this is not for you, then obviously you can go watch Tom, Dick, and Harry go play market replay. Okay, that's fine. But here, I'm teaching you things that actually work in the live markets. I'm not pulling some strings to make you feel like you're learning something that is a gimmick. This is real market delivery. Those of you that are really sincere about learning, obviously, you have a lot of work ahead of you. And we are in the development stages early on in this mentorship. So that means you have to understand that this is the discovery where you see this pattern. You're supposed to be going back through the data in your old charts, not trading, not even demo trading, okay? You're looking for this pattern through backtesting. Now, some of you have asked to do a backtesting episode. I will do a backtesting episode, okay? But I want you to understand that you have to have the proper mindset here. You have to be responsible. You have to be attentive, and you have to listen. So the things I'm teaching, the things I'm saying, suggesting to you, you have to make them applicable to your own journey. You can't just watch and think, okay, I've seen him do this a few times in the video. I understand it, so I'm going to go out here and try to do it. So I want you to understand, in light of that idea or direction that some of you want to take, just know that that's not the proper way of doing it, okay? So some of you are unaware that this is the other part of the ICT experience. So when I'm communicating to the community here, not only am I doing it in the comment section, very, very rarely, but I also talk on the community posts. And if you go on YouTube, go to my YouTube channel, and click on this little area right here, you'll see it's kind of like my Twitter, like my update area. Sometimes I'll prompt you to look at certain charts, or encourage you, give you ideas to think about where you are in your journey. And then sometimes I'll share a YouTube channel or a specific video. It's not meant for you to be able to talk to me here, but you can obviously say anything you want in the comment section. Just know that if it's something that's disrespectful, you can say whatever you want on your last post, okay? Because I'll just make you invisible. You won't be here anymore. And you can keep creating accounts, and I don't care. This takes one little click of a button for me. You gotta go through the whole freaking row of email addresses and all that business. And I don't get tired of hitting ban. I don't get tired of doing it. It's real easy. In fact, it's fun. But this area here is the other segment of mentorship. So with that in mind, I made this post a little while ago, and today's date is May 5th, 2022. And I know some of you try to remind me to make these posts with the date, and I don't remember it. So I'm used to doing Twitter, and Twitter used to do a time and date stamp all the time. It's just, I'm a creature of habit like anybody else. I don't really think about it when I'm doing it. But I made this post this morning. I said, good morning, constant reader. I know, right? That FOMC was pretty neat, huh? Now try this one. Open your NASDAQ 15-minute chart and even the S&P 15-minute charts. Drop a horizontal line across those smooth criminal highs in both index. I'll explain what that is in a moment. See how we dropped into a discount overnight. Study how they treat those relative equal highs today and non-farm payroll Friday, as you were. So I'm encouraging all of you to open up your charts and interact. Because some of you just want to watch my videos and that's it, and think it's going to translate from just watching and then now you know how to do it. No, you got to get in and study it. So I prompted everyone to look at their chart, and this is kind of what I was drawing your attention to. Now, as one caveat here, that little blue arrow, that is me drawing the specific, so that way we know what we're talking about here, where my attention was really drawn in on this. I'm watching this. Got that little bubble there. That little gap right there, I'm watching, and I'm waiting for that to drop down at 9:30. That's that little Judas swing. Okay, I'm waiting for that Judas swing to happen where it drops down at 9:30. If it goes into that area there, and then it creates displacement. Then it looks for a fair value gap. And if it trades back down into a fair value gap inside that displacement, then I can go long, and I'll look for a run into that 43.03. Okay? I did not tell my mentorship last night that I wanted to do this very thing here. But if I was going to tell my mentorship anything, this is what I would have said. Okay, I would like to see it drop down into that area and then create the model that I'm teaching here on the YouTube channel. Now, read what it says here. It says, you are studying this, and I am watching this. Okay? Pray tell, does this in any manner whatsoever suggest in any manner at all that any of you should be buying or selling this? No, it doesn't. For years, I've been asked to do live sessions. I've been asked to trade live in front of people, okay? The number one reason why I have refrained from doing it is what we're going to talk about next. Because responsibility is lacking, predominantly across all countries, all age and demographics. It's simply something that most people in trading lack, okay? Now, it's going to be very easy for me to sit in front of a chart and say, this is what I think is going to happen. I think it might go up to this level, go down to that level. That is not a trade idea. That's just bias. It's logic. That's the extent of what I'm going to do in the live sessions. The reason why I already said that in the beginning, and I didn't change gears because of what I'm going to talk about tonight, but it's important, okay? Mindset is absolutely crucial. If you young guys and gals in here are already bored, do yourself a favor. Turn this video off. Don't ever watch another video by me, because you're going to cheat yourself from the absolute best prevention of ruin if you continuously try to just watch my videos, pay intermittent attention, and then think you're going to glean any real understanding, because this is highly technical. I have simplified it, and you're going to see two very simplified approaches to what I'm trying to teach, so that way I can get right to the point. But these are the parts that cause people that don't want to listen, they don't want to pay the attention to the things I'm teaching you. These are the parts that will hurt you if you don't understand it. Do you want to succeed? Because to succeed, you need this part. Not the little patterns, not the little things I can draw on a chart. That stuff, that's the smallest part of it. How you think about yourself, what you think you're capable of doing, and the management and observation and respect of risk is going to determine what your success is going to be. I wish I could grab you by your lapels and just shake you and say, listen, this is the part you need to learn. It's not full of Lamborghinis. It's not full of Patek Philippe watches and flossing in front of everybody. I talk to you this way because I genuinely care about your success. That's all. That's all I want you to be able to do is take this information, the logic, and do well with it. I'm not trying to bore you or burn through minutes just for the sake of hearing myself talk. I want you to understand. And some of you simply don't want to listen. You have to be a critical thinker. I'm training you to be a critical thinker. I'm going to give you 2 examples tonight of what critical thinking is not. All right, this individual here was in the comment section, okay? And this is the poster child for why I do not sit in front of people and trade with entry, stop, targets. I don't do that. Because invariably, someone's going to take something I'm doing or saying or applying to a chart, and they're going to do something with live funds, and they're going to come out and say, just lost 1,000, thanks a lot. Now, I don't know who this person is. This person may not have actually taken a trade and lost money. This person may be a troll. This person may be a genuinely sincere individual. At this point, I don't care. But I want to highlight, this is the very thing, folks. This is it. This is the thing that prevented me all these years to sit in front of all you and entertain you with trading. Because someone's going to do something, and when they do something by their own actions, and it's painful for them, they lose money. Guess whose fault that is? Because it's not mine. It's the person that lost the money. Listen, everything I teach here is under the guise of demo and paper trading. That's compliance. I don't give trade advice. I can talk about where the market's going to go. I can give my opinion about that. Market opinions, that's not trade advice. It's the same logic, the same idea, and the same language that all of my paid mentorship students sign an agreement, and they give me indemnity. They know going in that everything I'm saying is under the pretense of demo and paper trading, and you can't make money with demo trading. But guess what? You can't do either. You can't lose money either. So it gives you that freedom to think about what you're doing without the tug of war of making and losing money. Some of you in here are so high-strung and so impatient that you just want to go out there and say, okay, I'm going to watch this video. I'm going to get a hint from ICT like I'm giving some kind of secret language for signal service. And I say this stuff to my own paid mentorship. I said it for 6 years. Every time there's a new group coming in, and know there's no new group coming in, and stop listening to these yahoos out there saying that I'm going to start another mentorship and I'm going to sell. I'm not selling no more mentorships, folks, because of this kind of stuff. Okay? I'm not doing it. So whether this person lost $1,000 or didn't, I don't care. That right there is why I have prevented myself saying, nope, I'm not going to do it. Because I know there's going to be a lot of you out here that are going to hurt yourself because you're not ready. None of you should be trading this model with live funds. We haven't even gotten through all of the content or the process of what it is you're doing with it. Today, you're doing another piece of it, but this is the crucial part. This is the stuff, the boring stuff, the things that you don't want to listen to, the things that you want to go through, the people that want to come in here later on and say, here's a minute marker when you start really teaching and you want to avoid the crap. I will delete your posts if you do stuff like that. It's disrespectful not only to me, but to the other viewers because you're really taking their attention away from what is the real lesson. You're all entitled to your opinion, but if your opinion is disruptive or disrespectful, I won't let it post. Now, you can disagree respectfully, and those posts stay on the comment section.
Right. So yeah, I had to have my microphone off. Oof. And I'm gonna prepare off stream. I'll make some notes off stream as well. I've just been listening. Go to episode 24, but I want to stop here. Okay. So I will return. Ooh, it's a lot of information. I'll be back. Peace.